As early as this week, and Alibaba's upsized buyback program fails to boost its shares as antitrust fears hit China's biggest tech giant. Now, European futures are pointing higher ahead of the open this morning. Remember, we're only going to see continental European stocks trade here. The UK is closed for Boxing Day. Of course, Boxing Day was actually on Saturday, but in the interest of humanity, the country gives people an actual weekday off for weekend holidays. I think it's a great policy. In any case, let's watch the European equity indexes open up live now. Typically, the FTSE is the first out of the gate, and that's going to make this a little bit more difficult. We're going to have to wait a little bit longer. It takes a while for the DAX Xetra system to open up, as well as the rest. Maybe we'll get the IBEX first. Yes, 0.9% the gain in Spain. It's mainly on the plane, of course. There you see the French CAC 40 open up 0.7%. We get the AEX usually next, and the AEX is actually positive year to date, so it actually has had a good 2020 as opposed to these other two. So has the DAX. In fact, if you look at the major European equity indexes, really it's only Stockholm's OMX, the AEX in Amsterdam, and the DAX that are looking at 2020 gains. There you see the FTSE MIB in Italy up 0.8%. In any case, we're seeing gains across European markets this morning, and it's mainly due to President Trump signing off on a coronavirus stimulus package. Or perhaps Europeans are happy about the Brexit deal as well. But here in Germany, the finance minister Olaf Scholz is defending part of his government's measures to fight the economic impact of COVID-19. The ruling coalition's cut on VAT taxes expires at the end of the year, and Scholz says the move means consumers won't postpone larger purchases because of the pandemic. Still, I think the more important piece of news here is that he won't extend those VAT tax cuts. Joining us now is Carsten Bresky, ING Germany chief economist. Carsten, what do you think about, well, let's talk first about the Brexit deal and what it means for the European economy. Is there any possibility that European equities are rallying on relief due to this Brexit deal?
Well, I think there is some relief because we still had this risk scenario out there that we could see a no-trade deal Brexit at the end of this year. And I think that the deal that we've seen now last week is probably the least disruptive that we could imagine. So I could expect some relief also in stock markets, because it simply means now that the status quo will continue, that transition periods are extended, and I think that this is the smoothest way that we could have imagined to see really Brexit unfolding as of January 1st.
Nonetheless, it seems that the U.S. stimulus is really behind the risk-on mood that's rippled around the world after President Trump signed that bill. What do you think about the German stimulus situation? I mean, I love that Olaf Scholz acts like an economist who knows what he's talking about, but still, it should put a damper on animal spirits that he doesn't want to extend these VAT tax cuts.
I think the German stimulus is a bit mixed. I remember we were all extremely cheerful at the start of the crisis in summer when Germany decided on this big bang fiscal stimulus packages, and they were enormous. There are two problems with these stimulus packages. One is that the biggest chunk of the money has not been used so far. So this gives it a very little bang of the fiscal stimulus. The second one is that we still don't know now about the second and third round effects, that there won't be any extension of this VAT reductions, which means there will be especially pressure on retail stores, on restaurants, on hotels, which could also use the VAT reduction as building up their capital buffers over the last couple of months. The other thing is we still have this kind of looming wave of bankruptcies coming in 2021, and we haven't heard any government reaction to how they want to deal with this coming or looming wave of bankruptcies.
Yeah, what do you think about the development? What can an economist forecast about the development of this recession? I think it's interesting the differences. For example, U.S. holiday spending, Carson, was up as opposed to in 2008. And Larry Summers wrote an op-ed piece for us railing against the idea of $2,000 stimulus checks because people have been really saving more. People have more money in their bank accounts now, and that's different compared to what we saw in 2008 when they were spending as much as they could on credit cards. Why is it different this time, and how is that going to play out?
There are a couple of differences compared with 2008. 2008, to some extent, was short-lived. We also saw short-lived fiscal stimulus. We also saw that this stimulus, especially in the lower income groups, was immediately actually used to spend. This time around, we saw the same pattern in the second and third quarter. So first, people were holding back their savings, and then in the third quarter, we're spending like hell again. Now that this crisis is continuing, that the lockdowns are continuing, that it's very hard to see some light at the end of the tunnel for people, they are saving even more. So this saving this year was probably more some kind of forced savings. Now it has become precautionary saving, and precautionary saving means that they will not easily spend it again in the coming weeks. So it will really depend, as so often outside of economics, vaccine, lockdowns. So the faster we can get this rolling out of the vaccine, the faster we'll see an easing of the lockdown measures, and then we will see a gradual recovery of the global economy. Maybe exclude Asia, because Asia, I think, is the only region which is experiencing a nice V-shaped recovery right now.
What do you think about the possibility of a recovery from this pandemic, Carson? I mean, here in Berlin, at least, I can't go to Ständige Vertretung. The bars are closed. I can't go to Brewdog or Borchardt. But I walked down to Kolskistrasse yesterday, turned right past Klärchen's Ballhaus, and the streets were packed with other people. So it doesn't look like the lockdown has kept anyone out of the public sphere.
I think that is the interesting part or aspect of the current lockdown. Like you rightly said, cafes, restaurants, hotel, retail stores are all shut down. This will continue, in my view, at least until the end of January. This will also mean that we will not see all of them reopening, because the pressure on their stability, the risk that we see bankruptcies will clearly increase. At the same time, it's also, it also makes us clear how hard it is to really lock up the Western society. So people really want to go outside, which means I think that people and societies will still have a hard time going through this winter month, because the real significant lifting of lockdown measures will only come probably only by springtime. Because when you look at the rolling out of the vaccine, it really starts only with the risk groups. So I think you and I, most people will still have a hard time, and they will try to go out, even if they cannot fetch a beer, a coffee, or eat out.
All right, Carson, we're going to keep you with us. I want to get your outlook. I want to get more on your outlook for 2021. Carson Bresky is the ING Germany chief economist. He stays with us. I do want to say it looks like For some reason, investors are buying German stocks today. The DAX has now reached an intraday record high. As I mentioned a few minutes ago, it's one of the few European equity indexes that's actually gaining year to date. If you take a look at the one-day chart isn't terribly interesting since we've only been trading for 8.5 minutes, but 13,760 is what we're looking at right now on the DAX, and we were up almost to 13,800. So keep your eye on European stocks. They're rallying across the continent. Closed, of course, in the UK today for Boxing Day, but the DAX index is up 1.3%. There's a 5-day view, and it shows, I think, a better picture of the spike at the open this morning. Now, things will get worse before they get better. That's what Carsten says about 2021. We're going to continue our conversation next with ING Germany chief economist Carsten Bresky. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open. We are 12 minutes into the session, and here you can see the gains across European equity indexes. The UK FTSE is closed today for Boxing Day, but the DAX up 1 1/3%, hitting an all-time high right now. Right now, 13,764, the level on the DAX. It's up, 3% year to date, I think. If you look at it in dollar terms, if you're a dollar investor, you've made 14% year to date on the DAX because of the strength of the euro versus the greenback, and that's almost as good as being invested in the S&P 500. I was looking at the breakdown of the winners and losers on the DAX year to date, and the biggest gainer today, up more than 3%, it's Delivery Hero. That's the biggest gainer year to date as well. Delivery Hero is up 74% year to date, beating out Infineon, Deutsche Bank, Merck, KGaA, and RWE to lead the DAX. I was just talking to Carsten about my Sunday stroll yesterday down to Kolskistrasse, which is one of my favorite streets here in Berlin, and also where you'll find the gigantic headquarters of Delivery Hero. They have such a big building on Kolskistrasse that I'm sure they only use a tenth of the behemoth brick building that they've got here, and the rest of it is just empty. Would be a great place for a loft apartment. In any case, that's the DAX and Delivery Hero. Let's get your Bloomberg Business Flash for you here. Today's top corporate stories from the terminal. BMW plans to build an additional 250,000 electric cars in the next 3 years. The carmaker's CEO, Oliver Zipse, says sales of electric vehicles will account for about a fifth of BMW's sales by 2023. That's up from 8% now. But he's concerned that Germany's transition to e-cars will be hampered by the disturbing lack of charging infrastructure in this country. U.S. holiday sales have risen by 3%, driven by a boom in online shopping. According to MasterCard, it's much better than the result during the last recession in 2008, which saw a drop of 3.5%. Online sales rose a whopping 49% from a year earlier. E-commerce now accounts for a fifth of all U.S. dollars spent in the holiday season. And that is your Bloomberg Business Flash. Now let's get back to Carsten Bresky and discuss his 2021 outlook. Carsten, you say it's going to get worse before it gets better. Where do you see the most pain coming? Is it this sort of cascade of bankruptcies that you expect, in Q1 and Q2 2021?
Yeah, I think first of all is the negative impact from the lockdown measures, because in my view, we will see an extension and maybe even stricter lockdowns after Christmas now, starting the new year. So this will clearly more ruin the start of next year for the entire European economy. The other one that you mentioned is the structural impact. And yes, we will see an increase in insolvencies, bankruptcies in the first 2 quarters. I think that is for clear. The only question is, as it currently seems to happen in the small and medium-sized enterprises, that the impact on the labor market could be less severe than during previous episodes of rising insolvencies in Europe and Germany. But clearly, so when we look at the labor market in all of Europe has been artificially supported by these short-time work schemes. And with rising insolvencies, rising unemployment, this is clearly putting a lid on growth in 2021.
So do you think we're going to see stricter lockdown measures here? I mean, we're supposed to see a lift on January 10th, but I believe Seehofer in the German media recently has said, maybe we're looking at more serious restrictions to come.
Especially when you look at Germany, I think the constitutional situation is that the government can always only announce lockdown measures for up to 4 weeks. This is why we have the deadline of the 10th of January. So it has nothing to do with the virus or anything else. So only with the German law. So and when you listen to politicians already ahead of Christmas, I think we will see at least an extension. And I think there is a high risk that we see even a stricter lockdown, which will, in my view, last at least until the end of January, so that we then have a first rolling out of the vaccine. And probably by March, with springtime hopefully arriving, we should see then also a clear easing of the lockdown measures.
So this brings me back to Scholz. And also, to some extent, Lagarde. I mean, what can the government here do? What can the ECB do in order to try and cushion the blow?
Let's start with the ECB. I think there's hardly anything the ECB can still do. Well, we had the big December meeting. Lagarde and the ECB made clear that they will kind of flood the European economy. They will offer cheap liquidity, cheap loans to banks, cheap liquidity, low interest rates, at least until March 2022. So this is the best the ECB can do, unless we would get another speculation about a Eurozone crisis. But for the economy, I think that is more or less what the ECB can do. It's again up to fiscal policies. And you can definitely argue whether an extension of the VAT reduction is the right way forward. Yes, sure, you can argue about it, but I think there should not be a discussion that there is more fiscal stimulus needed. And we discussed the US bill on fiscal stimulus in the US. I think Europe did well in spring and in summer, but it will also now depend on governments in Europe to really decide on more stimulus in the first half of 2021. Because don't forget, this European Recovery Fund that will now finally start will only pay out money in the second half of 2021. So we need to bridge these at least 6 months, and this will have to come from national governments. So Olaf Scholz will clearly, and I guess they will have something in their drawers, have to think about ways how to support all these companies that are now underwater and which are at risk of running into bankruptcies.
All right, Carsten, thanks very much for joining us this morning. Carsten Bresky is ING Germany's chief economist, and I really appreciate your time and your insight on this Monday. Coming up, Bitcoin's rally continues, but will the momentum last? We're looking at what's next for cryptocurrencies in 2021 after the massive rise to more than $28,000. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open. We are 23 minutes into the session and looking at an all-time high on Germany's benchmark DAX index, right now trading at 13,782. It's only up 3% year to date, but if you look at it if you're a dollar investor, first of all, you're up either very late or very early. And second of all, if you're in the DAX, you're up 14%. So it's been a good year for dollar investors there as well. Now, let's talk about another currency that some might consider a commodity. The initial price of Bitcoin set in 2010 was less than 1 cent. On Sunday, the world's largest cryptocurrency breached $28,000 for the first time before pairing some of the advance. The digital coin has more than tripled in price this year alone. So can Bitcoin sustain its rally in 2021? Or are we going to see a repeat of past Bitcoin bubbles, which would, for devotees, represent an incredible buying opportunity? Our cross-assets reporter Eric Lamb, who covers Bitcoin regularly, joins us now to talk about the currency. Eric, where do you see Bitcoin's price going next year? What are you hearing from your sources?
Yeah, that's the big question, isn't it? And I'm sure a lot of people were talking about that over the holiday weekend when we saw that price spike up to 28,000. The latest that we're, talking about, the latest level, we love those round numbers. 30,000 is kind of the next level we're watching for here. There's also a Deutsche survey recently where a majority of people actually expect the Bitcoin to rise even higher next year, with I think about 40% of people saying it could hit over $40,000. So there's certainly more room to run here. But as we all recall, back in 2017, we had that massive rally and then just a sudden collapse as well. And people who have been watching crypto over the last few years are used to those bull runs and almost expect them. But I talked to someone earlier today who thinks that maybe in the next little while those drops might not be as dramatic. We might only see a pullback of 10 to 15% rather than the real big drop that we saw back in 2017 when the bubble burst.
How does Bitcoin compare with other assets? And I don't just mean, other cryptos, but gold, for example, I think is an interesting comparison over 2020.
Yeah, that's interesting. Bitcoin often does get compared to gold, and at least for this year, when it comes to performance, there really isn't a comparison. Bitcoin's up almost 300% this year. Gold is up 25%, which in most years is a pretty great year for gold, but it's nowhere near what Bitcoin's doing. The S&P 500 is up about 15% this year. Again, decent year for stocks, but not comparable to Bitcoin. And it does kind of go into that conversation back and forth about whether Bitcoin is a storage of value or a speculative asset. And at times it's either one or the other or both, depending on who you're talking to. Certainly for this year, it's been the subject of great speculative returns, but also has been seen as a storage of value against certainly all the calamity of the global pandemic.
All right, Eric, thanks so much for joining us. Eric Lamb there covers, our cross-assets reporter. Among those assets, he covers very closely Bitcoin as well. Let's take a look at some of your movers. We told you about Lufthansa saying in Welt am Sonntag that the CEO, Carsten Spohr, gave an interview saying they'd cut costs more than expected. They have 10 million in liquidity. They only used, 10 billion in liquidity. They only used 3 billion of the 9 billion euro bailout package that they got. So investors very happy about that. The stock up almost 5%. Delivery Hero up 3.5%. It is the biggest gainer on the DAX this year to date as well, up 75%. So Delivery Hero helping drive the DAX to a record high. And then you see CD Projekt, the, I guess, embarrassed right now maker of Cyberpunk after lawsuits down another 2.7% due to all of those bugs and glitches. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open, 30 minutes into the session right now, and looking at an all-time high on the DAX indexes. European stocks are trading today on the continent. The UK is not trading today. They've been given the day off for Saturday's Boxing Day on this Monday. But here you see the Stocks Europe 600 index currently gaining about 0.6%. Up to almost 400, 398.40. The DAX right now is up more than 1% to 13,809. So the DAX, actually, I see it up 1.6%. Sorry, this is 1% over 5 days. That's right. So today's gain is 1.6%, and the level 13,809 is an all-time high for Germany's benchmark index. So being powered by Delivery Hero, as well as chipmaker Infineon and Deutsche Bank. Those are the top 3 gainers year to date. The DAX rises to an all-time high. Let's get to Bloomberg First Word News. Here are today's top stories from the Bloomberg terminal. The one really driving markets: President Trump has signed the $900 billion relief bill passed by Congress. He's backing down from demands that lawmakers change the bill before he sign it. The president, though, is still calling for a vote to increase the $600 checks the bill provides to $2,000, but that non-binding request is unlikely to pass. He gets support there from Nancy Pelosi, interestingly, but not from other Republican lawmakers. In Great Britain, the UK is poised to approve the COVID-19 vaccine produced by AstraZeneca and the University of Oxford. Bloomberg sources say the regulator could clear the shot for use early this week. The Sunday Telegraph reports it could be rolled out from January 4th, so a couple of conflicting dates there. Nonetheless, soon is the idea. The UK has already vaccinated more than 600,000 people using the vaccine from Pfizer and BioNTech. The European Union has begun a coordinated vaccination campaign less than a week after clearing the shot by Pfizer and BioNTech. It'll take months to vaccinate enough people to have an effect on the spread of the disease. European Commission President Ursula von der Leyen says it will be a gradual process and caution is still necessary. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Now, the UK and the EU have finally reached a post-Brexit trade deal, but there will still be significant changes for people and businesses come January 1st. Bloomberg's Anna Edwards takes a look.
No matter what, the UK's relationship with the EU is changing. Europe's 4 freedoms of movement will no longer apply from 2021. For Brits travelling across the Channel, you'll need 6 months on your passport and only be able to stay for 90 out of 180 days. Want to live and work? Well, the withdrawal agreement protects the rights of those already abroad, but to move in the new year, there will be new costs and residency requirements. Goods trade will see more friction. There will be new customs declarations, special certificates to move food, animals and plants, and you'll need the right paperwork to even get close to some UK ports. To avoid chaos, the UK is giving importers a 6-month grace period, but the EU is not following suit. There are changes for services and capital too, though a lot remains unclear. The City of London is set to lose its automatic right to sell into the EU. The UK has granted broad equivalence to EU capital, auditing and insurance, but Europe has been narrower, granting just temporary equivalence for UK clearing, and is in no hurry with other financial services.
That was Bloomberg's Anna Edwards there, looking at the significant changes for people and businesses due to come in on January 1st with this new deal. Staying with Brexit, let's get to this week's Brussels edition. Here with a guest is Bloomberg's Maria Tadeo. Maria?
That's right. Good morning, Matt. And we are joined by Sandro Gozzi, who is a member of the European Parliament for Renew Europe, and he's also the former Italian Minister for European Affairs. And Mr. Gozzi, when you look at the deal, who do you think is the biggest winner?
But there are no winners. It was a lose-lose process, and we both lose. It is a damage limitation process. I think that, of course, overall, UK is losing much more than the EU. But I repeat, we have limited the damages coming from the decision of UK to leave the EU.
Right, and we still have to ratify this deal. When is the European Parliament going to put this to a vote?
The European Parliament now must look into the deal. As you know, it's a very long document, I think 1,500 documents all in all. And we will take our time, of course, to look into that. I do believe that it could be in February. We are talking about the 8th of February, but the date is just being discussed now. It's not fixed yet. It is clear that, I mean, we will have to look specifically into the deal, which I repeat, it looks like a positive deal within a negative context.
Right. So just to pick up on what you said, because this does matter, especially for markets and the implications that it may have. What you say is that this is going to be put to a vote. It needs to be ratified, but it will probably not be in January. It's more of a February now situation.
Yes, I repeat, the date is being discussed, but it's more likely, it looks more likely than the Parliament could ratify in the beginning, in the first week, in the first decade, the 10 days of February, more than in January. And you know that it is, I understand the interest of the market, but this is a deal which concerns more trading goods and movement of people. You know that the financial services are practically completely excluded from the deal, and I think that this is a major loss for London.
Right, and as you mentioned, it's hundreds of pages. Have you been given the document, I wonder, and what areas specifically do you want to focus on?
No, I mean, I haven't started to look into the matter. I'm a member of the Internal Market Committee. It is clear that we will look very carefully into everything affect the good functioning of the internal market. It is clear that the issue of state aid and mutual control on state aid given to European or to British firms, it will be a major issue for us, but also the respect and at least a certain convergence on environmental and social standard, which is a condition for us to keep our market open to the British firms, will also be one of the issues that I will look very carefully into before the final vote of the European Parliament, as I believe in February.
And Mr. Gozzi, when you look at the documents and the deal itself, it's clear that it's no quotas, no tariffs, but the EU does say there is a right to arbitration and potential tariffs in the future. I wonder how solid is this relationship, however, down the line?
No, the relation is solid. The relation is solid, and this deal it has turned Brexit into radical change, but not a dramatic change in the relationship between EU and UK. And I think that the fact that we got a deal, it's a very positive basis on which we can build up a new partnership between EU and UK, which is totally to invent. After all, it's the first time that we spend almost 4 years on a trade agreement, not to dismantle barriers, but to introduce new barriers, new obstacles to trade. It is true, as you say, that we reached what we wanted both in Brussels and in London, an agreement which is based on no tariff and no quota, but there is a lot to shape for the future relationship. In the financial service, for example, you know that the clearing houses are granted for the city only in 2021. UK doesn't have a financial passport anymore. There are several issues linked also to security and cooperation in the field of security. So, I mean, there is a lot to do in the future. I think that Brexit is not gone. I think that it will be a very long process which will keep us busy both in London and Brussels. But I repeat, the fact that there is a deal allows us to start the new phase on a positive basis.
Right, and just as a very final question, you say that Brexit to some extent is not done, but you know very well there's many commentators, especially in Brussels, who say it does signal the end of populism. We have Trump leaving the White House. We have this deal now in place. Would you say this is it for the surge of populism that we saw just take hold in Europe for years?
I'd like to say it. I'd like to say it. Certainly, I mean, the worst year for us and the best year for nationalism and populism was 2016. Brexit, Trump, in Italy, we lost the constitutional referendum. The Five Stars movement were raising up, the extreme right, post-fascist in Italy, Marine Le Pen, all this stuff. It was mainly in 2016. Now Trump is gone. There is it was a point of reference for all the nationalists and populists in Europe. And without having the American president, it's certainly for them more difficult. But I think the fight against nationalism and populism is still on. We have to still pay attention. And I think that the recovery plan and all that Europe is doing as a response to the COVID-19 crisis, the distribution of vaccine, the major resilience and the recovery facility, the plan of 750 billion euro to relaunch the economy in the continent. These are all the right answer to the populists and nationalists, which are weakened, but they are still there. We have to completely defeat them.
Right. Well, Sandro Gozzi, thank you so much for your time. Member of the European Parliament for Renew Europe. Thank you for joining us on Bloomberg this morning. Matt?
All right, Maria, thanks very much. Maria Tadeo there with a look at the results, the outcome of the Brexit deal. Up next, we're sticking with Brexit as we take a look at the future relationship between the UK and the EU. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open. We are 45 minutes into the trading session. Looking at a 1.4% gain right now in the DAX. It's up 193 points to an all-time high. If it closes at this level, 13,780 is what we're seeing on the German benchmark. Now, back to Brexit. The trade agreement that was struck on Christmas Eve may have brought some welcome relief to businesses, but From finance to fish, the long-sought deal is still shrouded in uncertainty on major issues. Joining us now is Ulrich Hoppe, Director General of the German-British Chamber of Commerce. Thanks so much for your time this morning. Director, what do you see as what is your summary, I guess, the executive summary of this trade deal for you?
This deal is better than no deal, because we at least are avoiding tariffs and quotas, and that is really important to keep trade growing. So it is really the best of two not really very good options, but it is the better one, and it is important to have a foundation for the future, because Brexit is not going to go away. Maybe it is going to go away by name, but I think there's so many more issues to be sorted out over the coming years, and we need to have a foundation on which to build. If we hadn't had reached a deal, that would have been far more difficult. But of course, this deal will bring massive changes for businesses, even for trade in goods, because there are many more formalities. These are administrative burdens, administrative costs, which are have to be borne by companies, and will they eventually be passed on to the consumer? That is the big question. So life will become more expensive, and of course the world in this smaller setting, EU, UK, deglobalizes a bit, and that always has repercussions in terms of efficiency of the economy. So I think it is good that we've reached that deal, but changes in the air, and that's going to be having an effect on especially the British consumer and the British economy.
What is the biggest problem, Ulrich, for the German-British Chamber of Commerce? I mean, when I think about the cross-border trade, maybe just because it's so big in terms of numbers, car makers come to mind. You've got BMW, which owns the Mini brand over there. Of course, members of the royal family have famously driven Volkswagen Golfs. BMW is a huge brand. Mercedes, obviously, even bigger. Is that the biggest issue to deal with right away?
I think for the German car industry, who only exports to the UK, I think that the trade deal is a relief, because we've avoided tariffs. So that's important. And also for BMW, which produces in the UK as well as Bentley, I think for them it's also important that they can actually export from the UK to the EU tariff-free. So that is important. But how the future regulatory framework will develop, that's a key issue for them. Rules of origin with all the other trade agreements are still issues which need to be looked at. And then especially if we look at the interconnectedness in terms of high-level services, in some of your reports you mentioned financial services, but there's much more than that. And that will become more difficult, first of all, in terms of market access, but also with the new immigration law, which also is a result of Brexit, which will make the cross-border movement of people far more expensive, and in some, or in a number of cases, impossible to provide cross-border physical services. So I think there are more issues there which will only emerge over time, because I think we've underestimated the interconnectedness of the European economy. So it's not just goods. I think services and not just financial services, is 2/3 of our economies, and that really has a big influence on future economic growth. So there are many more hurdles to come, and I think the detail we'll find out over the coming months and over the coming years, and that there needs to be a basis to really iron out all these differences which haven't been overlooked and haven't actually been properly analyzed, so that we can actually carry on having this connectedness, even if Britain is not part of the EU anymore.
So what's the biggest issue for the German-British Chamber of Commerce? I mean, where do your lobbying efforts go first?
So firstly, they go into keeping a regulatory alignment, and then also to have the ability for companies in our community to attract the right number of staff, and also to have easy immigration rules. Of course, Britain wants to have control over its own borders. That is absolutely fine, but it is the lack of skilled labor in many areas in the UK, and that's not going to go away soon. And therefore, there needs to be flexibility on this front, so that companies can actually carry on working and operating in the UK to the most efficient level.
All right, Ulrich, thanks so much for joining us. Ulrich Hoppe there, Director General of the German-British Chamber of Commerce, talking about post-Brexit deal dilemmas. Turning to the markets, U.S. futures trade higher, the dollar edges lower. This is after President Donald Trump signed a coronavirus stimulus package. Finally, Coming up, we'll discuss the market outlook with Richard Jones, our MLive FX and rate strategist here in Berlin. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open. We are 53 minutes into the session right now and looking at big gains here in Germany, led by Delivery Hero and Lufthansa. The DAX is up 181 points to 13,768. The UK is, of course, closed today for Boxing Day. Now, Richard Jones, our MLive FX and rate strategist in Berlin, joins us now to discuss a number of issues. Chief among them, I guess, this record that we're looking at here, Richard. I mean, most European equity indexes are down year to date, the exceptions being the AEX in Amsterdam, the OMX in Stockholm, and the DAX. Why is Germany doing better than the rest of the continent in terms of its equity rally?
Well, good morning, Matt. Well, I think there's a few things going on. I think today equities in general are actually breathing a huge sigh of relief that President Trump signed the pandemic aid bill. And I think just in general, that sets a smooth end for markets to 2020. This last week, I think, into year end should be fairly smooth. You know, I think one of the things that is driving German outperformance, especially today, is the fact that I think autos as a sector is one of the big movers today. And I think that the Brexit trade deal is being greeted with a sigh of relief from Germany, because they can actually now continue to export their BMWs and their Mercedes into the UK tariff-free. And I think if there would have been the alternative, a no trade deal end to this current transition period, I think that probably would have hit the auto sector pretty hard in Germany. I mean, I think the UK is not the biggest market for German exporters, but I think it's one of the big ones. And I think there is a sigh of relief going on in German equities, especially in the auto sector, because that trade deal was concluded and it's good for German exporters.
All right, so a lot for German investors to cheer. Let's talk about that Trump signature. What does that mean for the U.S. economy? What does that mean for global markets, Richard, that they're going to get not only the budget, but also the pandemic relief bill through?
Yeah, so I think after a week or so of actually criticizing the bill and saying that the $600 checks are far too small and that he would like to see bigger checks distributed to U.S. citizens, the president actually signing this bill was a big thing, because if he hadn't done it, I think we would have had some dramatic moves in the markets, because I think the markets had very much priced this in. The negotiations have been going on for weeks and weeks and weeks, and so I think if the bill hadn't been signed, you would have had some households facing a fiscal cliff edge at the end of the year, given that some of the benefits ran out at the end of the year. So I think the fact that the president signed it ensured that we do get some sort of pandemic relief measure. We could be getting more from the Biden administration, but at least now as a stopgap measure, the market had priced this in. The market's happy that the president signed, and as I said, I think it now sets up a pretty smooth year end for markets.
All right, Richard, thanks so much for joining us. Richard Jones there, MLive FX and rate strategist out of Berlin. That's it for the European Open. Stay with Bloomberg Television. Up next, it's Bloomberg Surveillance, and I will be coming back to you later on in the day with my old partner, Carol Masser. That's something you definitely don't want to miss. If you're in the U.S., that's at 7 a.m. Eastern Time. If you're in the U.K., that's bang on noon. This is Bloomberg.
President Trump signs the $900 billion virus aid bill, but continues to push for $2,000 checks. Futures trade higher. Europe is 24 hours into its vaccination campaign. This as the UK looks poised to approve AstraZeneca's vaccine as early as this week. And Alibaba's upsized buyback program fails to boost its shares as antitrust fears hit China's tech giants. Very good morning to you. Welcome to Bloomberg Surveillance. I'm Anne-Marie Hordern in London, in for Francine Lacroix. Let's check in on where we trade this Monday morning, the last Monday of the final trading week of 2020. Many people are very happy to bid 2020 goodbye. Stock 600, the benchmark here in Europe, up 0.6%. We should remind you some European markets, and including the FTSE 100 in the UK, is closed today. It is technically the Boxing Bank holiday Monday. S&P 500 futures also getting a lift, extending those gains up 0.6% as well. All of this, of course, the market is cheering on the fact the President of the United States did sign the $900 billion relief aid, and then a 10-year yield. You can see that yield 95 basis points. So money moving out of Treasuries, yield coming up, as well as money moving out of the weaker dollar this morning. Change over the boards. We're looking for full screen number 2. We do have the pound trading this morning, 135.47. Failed to break out of the range bound, even though we did have a trade agreement, although many will say there's so much lacking and questions still remained. There's still a lot of negotiations that will be happening between the UK and the EU going into 2020, especially when you look at the services sector. So the pound under a little bit of pressure today against the dollar. Bitcoin this morning trading under 27,000. The big move for Bitcoin was between Christmas Eve and on Sunday when it rallied more than 20%, piercing through 28,000, a new record for Bitcoin. It's still holding some of those gains. We're up 9% this morning. And Alibaba under pressure alongside a number of online companies in China. And this comes, of course, as antitrust fears are really triggering another sell-off. On Thursday, Alibaba in New York fell 13%. A big question is this just going to be for Jack Ma's empire, or is that contagion going to start to spread across other assets when you look at these Chinese companies? Now, we start, though, with our top story coming out of the United States. President Trump signs the $900 billion pandemic relief bill. The backdown from the president's last-minute demands avoids a government shutdown and delays to the widely supported aid package. Now, the legislation, which passed Congress last week, includes $1.4 trillion to fund federal agencies through to September. While signing the bill, Trump demanded a vote in Congress to increase the $600 stimulus checks to $2,000, a non-binding request unlikely to pass both chambers. Let's get more with Bloomberg's Bruce Einhorn. Bruce, good morning or good afternoon. I know you're over in Asia. Thanks so much for joining us. Less than a week ago, Trump called this bill a disgrace, but now he's signing it. What really has changed since then?
Nothing's changed in the bill. The same bill that he said was a disgrace last week is the one he's now signed. So, as you pointed out, he's issued a statement saying that he's demanding that Congress make all sorts of changes, that they get rid of a lot of spending that he wants rescinded. But that's not the way the process works. He signed the bill. It's now a law. He can ask Congress to make changes, and they can ignore him, and the Democrats in the House will do that.
What's Congress going to do now that he signed it? I mean, it's not realistic to really think that these stimulus checks will get a boost, is it? Because it seems like that's not going to work with the Republicans.
Well, you're right. So the Republicans generally are opposed to that, even though President Trump has called for it. So you were going to have this situation where the Democrats, led by Nancy Pelosi, will reconvene, the House will reconvene, the Democrats will pass this, the addition of the relief to $2,000, then that will then die in the Senate because Mitch McConnell doesn't want to put his senators in a difficult position, especially given the runoff in Georgia shortly after the holiday, early in January, where 2 Republican senators are running, and that will determine who controls the Senate. And many Republicans oppose this. It's an unpopular vote because many people want the additional money. So I think it's a good bet that Mitch McConnell will do his best to make sure there's just no vote.
All right, Bloomberg's Bruce Einhorn, thank you so much for joining us. Digging a little bit deeper into what all this means and digest the markets this morning is Lothar Mentel, CEO of Taton Investment Management. Lothar, very good morning to you. So stimulus uncertainty is removed, but of course, not before a week's additional pain for millions of Americans who are banking on these payments. Is this material to an economic point of view, and should it feed into sentiment, or are markets just well past this?
I would say markets are past this. It's inconvenient. It's not great for those families who've missed out. But the big and important thing is that the package overall has been passed.
What's the next positive catalyst then for 2021? Will we get fresh fiscal support with a new incoming Biden administration, or are you going to wait to hold off to see what plays out next week in the Georgia runoff?
I think that's exactly it. So we'll have to see a little bit and wait a bit more what's really going to happen with the Georgia election, what the situation in the Senate is, what sort of fiscal package the Biden administration could actually put through. But for the moment, I think it's positive for the U.S. economy that this has happened, that this is now in train, and that we've got that bridge over the next part of the pandemic until we get into the more vaccine-driven relief that comes in months, not weeks, unfortunately.
So we have in 2021 happening is more people getting vaccines, more fresh fiscal support. Do you see now inflationary pressures starting to build going into the new year?
Mild and probably very much in very certain areas, but not generally. We just still have a more deflationary environment where the demand isn't outstripping a supply only in very specific areas. So no, inflation shouldn't really be the issue initially. Maybe in the second half, that's what we're more worried about, that perhaps central banks may then lose their resolve to be there with their monetary support to back up the fiscal support that's coming from the government.
Do you think the Fed, if we do see that towards the back half of 2021, does the Fed, though, hold its nerve?
I should think that the Fed will hold its nerve. I'm not so sure about some other central banks if inflationary pressures are deemed to be coming through. But as I said, I'm not really too concerned about inflationary pressures at the moment. It may not be something that's coming through. Let's not forget, in the last decade, we always had the issue of more supply rather than too much demand. So it would be a nice change as all of a sudden we really had a big demand drive that is driving some price pressures.
Lothar, in your note, of course, we're in that weird week between Christmas and New Year's, and in your note, you talk about the outlook for 2021, and you say the Grand Canyon, the view is above you, on Everest, it's below you. As we head into this new year after 2020, that I don't think anyone's outlooks for 2020 held up, where do we stand? Are we in a Grand Canyon kind of moment, or is this an Everest moment?
Probably somewhere in between. I think it's pretty much consensus that 2021 will be better than 2020. It's just got to be. There's not much doubt about that. But how good it will be is very much the question. Are we just bouncing back? Are we seeing something similar to what we saw in last summer, or are we getting a more sustained recovery? And that's really going to be driven by whether the fiscal support can hold up, whether things come through on the monetary side. That is really going to be the big question here. And then also, let's not forget the private demand. Is housing going to hold up pretty much as we expect? Are people going to move? Are they going to make that change after having spent so much time at home during lockup?
Right. The post-pandemic world may not look so normal to the pre-pandemic world. Lothar Mentel of Taton Investment Management stays with us this morning. Let's get a recap and your Bloomberg First Word News. What else you need to know this morning? The United Kingdom and the European Union have finally signed a post-Brexit trade deal. But speaking to the Sunday Telegraph, Prime Minister Boris Johnson admits it doesn't go as far as he wanted on financial services. There's still little clarity on so-called equivalence that allows firms to sell their services into the EU's single market. The internet empire of billionaire Jack Ma is facing increasing pressure from China. Regulators are telling his financial firm Ant Group to go back to its roots as a provider of payment services. It's threatening to throttle growth in its lucrative business of consumer loans and wealth management. Ant says it's creating a special team to set up a timeline for the overhaul. And U.S. holiday sales have risen by 3%, driven by a boom in online shopping. According to MasterCard, it's much better than the result during the last recession in 2008, which saw a 3.5% drop. Online sales rose a massive 49% from a year earlier. E-commerce now accounts for a fifth of all dollars spent during the holiday season. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Coming up in surveillance, the EU begins its vaccination program while the UK is poised to approve another COVID shot. We'll bring you the latest developments on the vaccine front. This is Bloomberg.
It is critically important that the markets stay open in this time as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, and politics. Good morning. This is Bloomberg Surveillance. I'm Anne-Marie Hordern in London, in for Francine Lacroix. Now, the European Union has begun a coordinated vaccination campaign less than a week after clearing the shot by Pfizer and BioNTech. It will take months to vaccinate enough people to have an impact on the spread of the disease. European Commission President Ursula von der Leyen says it will be a gradual process and caution is still needed. Meanwhile, this comes as the UK is poised to approve the COVID-19 vaccine produced by AstraZeneca and the University of Oxford. Bloomberg sources say the regulator could clear the shot for use early this week. So Lothar Mentel of Tatton Investment Management still with us. Lothar, we can go going into 2021 with the UK actually getting the AstraZeneca vaccine, which would be good news for a lot of places around the world, considering the fact that it doesn't involve as much of the big logistic problems, the refrigeration, that the others. Do you think that now with Europe also finally starting to vaccinate, is there more risk to the upside when you look at European assets? Is now a time you would want to buy European assets? Brexit, somewhat a trade deal for goods is done, plus vaccinations. Is this positive?
It is all very positive. It's positive and should be positive for the economy, but let's not forget the markets had anticipated much of this happening and therefore priced it in along the way. And we obviously, as investors, had not got such a bad 2020 as so much rest of the economy. So I'm afraid, I wouldn't want to be out of the markets, but I'm not getting super excited about what may be on the upside.
Given how badly the UK suffered due to COVID, and recently the scenes from Dover giving us a little bit of a glimpse of what could have happened if there wasn't a goods trade agreement, certainly I think a lot of people are saying this is a sign of relief, breathing a sign of relief that something was done before December 31st. But going into the negotiations into 2021, we still don't know a lot about services. Do you think the UK comes in with a weaker or the upper hand in this?
I think the UK is coming into this with the weaker hand, unfortunately, because obviously the economy has suffered more here. We're more dependent on the recovery. We haven't participated or haven't been able to benefit from the manufacturing upswing because we haven't got that much manufacturing. So services is very important. I mean, it is positive that we're going into this with a deal rather than with no deal. A deal is better than no deal, but let's not kid ourselves. It's a skinny deal. It doesn't do anything yet for services. We still have to negotiate that. And the city is not feeling particularly positive towards this at the moment, but we're hopeful that with a deal on trade, we should have a good platform to negotiate something on the services side. And let's not forget, the City of London, the financial centre in London has a lot of mass, a lot of critical mass that is important for the rest of Europe as well. So I'm relatively optimistic on that side of the question.
Do you anticipate any market disruption next week as this transition period ends without much clarity on what exactly is going to come next?
No, not really. We're also still expecting certain transition things to be extended. And with all the organizations in the city really having expected and anticipated a worst case scenario, because we had to, with all our contingency planning, I do expect things to be relatively smoothly. There may be the hitch here or there, but it's certainly not going to be some big chaos that you might have expected had things gone with no deal, at least at the borders.
This morning, Lothar, the pound 135.55. So we're still trading range bound. It hasn't broken out, even though there has been what you would call a skinny deal. Is the fact that there's no clarity or little clarity on financial services what is holding back the pound from rallying further?
No, I don't think so. I mean, the pound had priced in a deal long before we actually got one, and therefore that's why there's not that much upside there. And all the rest is really now this discrepancy of economic recovery between the UK and the rest of the world. We are lagging in that respect, and there's currently not that much material upside visible beyond what's already priced in anyway. So it's now really back to the COVID story, to the pandemic story, and how much of a recovery we might get.
All right, Lothar Mentel of Tatton Investment Management stays with us this morning. Coming up next, we're going to looking at what's going on in China. Regulators ask Ant to return to its payment routes and overhaul its entire business model, taking aim at Jack Ma's internet empire. We discuss that next. This is Bloomberg. 9:22 in the city of London. Good morning. Economics, finance, and politics all here on Bloomberg Surveillance. I'm Anne Hodern in for Francine Lacroix. Now, Chinese regulators have ordered Jack Ma's Ant Group to overhaul its business model and return to its roots as a provider of payment services. And said it will set up a special team to comply with the demands. Our Asia investing editor Lulu Chen joins us now for more. Lulu, let's start with Ant Group. There's a lot going on in the Asia trading session. What is the PBOC demanding, and how will this actually affect its future ambitions?
So the Central Bank of China has told Ant that it needs to understand the necessity of overhauling its business. Ant's business stems from everything from wealth management to credit lending and insurance and payments. Our understanding is that while the PBOC said it needs to go back to its roots, it's not saying that the company needs to stop operating all those other businesses. Instead, what the regulator has told Ant is that it needs to come up with a proposal and a timetable to hand back to the regulators and see how they can become more compliant with the regulatory measures in those separate business areas.
This also coincides with what we saw last week, which is scrutiny of Alibaba. How worried do you think Alibaba is about the latest that Ant is now facing from China?
Well, Ant is facing an unprecedented regulatory challenge, especially because the IPO halt was so high profile. It was supposed to be the world's largest IPO. On the Alibaba front, its affiliate, which owns a 30% stake in Ant, Alibaba itself is also facing regulatory scrutiny from the anti-watchdog Bureau. Right now, the company said that it has been investigated by the Anti-Watchdog Bureau as of last week. Regulators came into the company headquarters and they took the research and investigations on site and concluded those investigations within the day, according to local media reports. And as of now, we're still waiting to hear back from the company and regulators on what their conclusion is.
All right, Lulu Chen, Bloomberg's Asia investing editor. Thank you so much for covering this for us throughout the morning. Lothar Mentel of Tatton Investment Management is still with us this morning. Lothar, my question to you regarding this is what's going on with Ant and Alibaba? Is that a huge red flag for investors that are looking to China?
Not necessarily. It's not pleasant, but it was sort of on the cards and foreseeable. And I think investors do recognize that China is not quite the same as the West. So I wouldn't see it as a massive, huge red flag. I think we all saw this coming.
So do you think this is idiosyncratic to Jack Ma's internet empire, or is there risk that this is going to spread to other Chinese companies?
I think you will see the involvement of the state in other Chinese companies all the time, particularly when they rear their head and do something that isn't perhaps quite as expected by the Chinese or quite as liked by the Chinese government. And I think that there's some positives in that as well, in that, it can indicate a real regulatory oversight that perhaps we've been missing in some other stories of last year. Would have Wirecard happened had the German regulator had a similar oversight regime as the Chinese are displaying here at the moment.
All right. Our thanks to Lothar Mentel for joining us this morning. He's from Tatton Investment Management, CEO. Happy holidays and Happy New Year, Lothar. See you in 2021. Coming up on the program, from tourism to green tech, why Volkswagen is betting on a Greek island to become the next big thing in electric vehicle development. We're going to speak to the Deputy Foreign Minister of Greece next. Stay with us. This is Bloomberg.
another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Economics, finance, politics. Good morning. 9:30 a.m. in the city of London. This is Bloomberg Surveillance. I'm Anne-Marie Hordern in for Francine Lacroix. Let's say where we trade. It's the final trading week of the year, and this Monday morning we are kicking off to the upside. The Stock 600 this morning is up 0.6%, really being led by cyclicals, chemicals, construction, auto parts. All of those sectors are up more than 1% this morning. All of this comes as we get a little bit of a clearer picture this Monday morning on Brexit, and certainly a clearer picture when it comes to U.S. aid when President Donald Trump signs that bill. S&P 500 also moving to the upside 0.6%. We have money leaving Treasury market yields up 95 basis points. And then the DAX this morning is really the outperformer when you're looking at where pockets of the world is really trading a lot. There's going to be lighter volumes, but the DAX this morning hit an intraday record at one point, and right now we trade north of 1% on the DAX. So certainly one of the outperformers on this risk on day. And all of this comes, as I mentioned, President Donald Trump signing a bill containing $900 billion in pandemic relief. Now, the backdown from the president's last-minute demands avoids a government shutdown and delays to the widely supported aid package. The legislation, which passed Congress last week, includes $1.4 trillion to fund federal agencies through to September. And signing the bill, Trump demanded a vote in Congress to increase $600 stimulus checks to $2,000. A non-binding request, which is unlikely to pass both chambers of Congress. Now, former Treasury Secretary Larry Summers told Bloomberg that raising the size of direct checks doesn't make sense.
We're better off with stimulus than we are without stimulus. I don't think the $2,000 checks make much sense. The real issue is going to be sustaining this expansion. If you think about it, the 908 stimulus bill probably would pay out $200 to $250 billion a month for the next 3 months. The level of compensation is running about $30 billion a month below what we would have expected it would. GDP is running about $70 billion a month below what we would have expected it would. So in a way that's quite unprecedented, we have stimulus already much more than filling out the hole. And given that lots of the hole is from the fact not that people don't want to spend, but that they can't spend because they can't take a flight or they can't go to a restaurant, I don't necessarily think that the priority should be on promoting consumer spending beyond where we are now. So I'm not even sure that I'm so enthusiastic about the $600 checks. And I think taking them to $2,000 would actually be a pretty serious mistake that would risk a temporary overheat. I would like to see more assistance to state and local governments. I would like to see more money put into testing, more money put into accelerating vaccines. But gosh, David, I think it would be a real mistake to be going to $2,000.
Larry Summers, the former Treasury Secretary, of course, speaking with Bloomberg on stimulus and direct $2,000 checks to our very own David Weston. Now, this morning, we have an exclusive interview. Greece is ramping up its bid to become a leading European center for the development of electric vehicles. Volkswagen, of course, the world's biggest car maker, has launched a pilot project which could transform an island in the eastern Aegean Sea into a green mobility hub. More recently, Greece has also signed a memorandum of understanding with electric vehicle maker NextEgo Mobile and another with tech giant Microsoft. Joining us now is Kostas Fragogiannis, Deputy Foreign Minister of Greece. Kostas, very good morning to you. On the heels of these big investments we're seeing from Volkswagen, Microsoft, some really massive names, can we expect other big names to come in and invest in Greece with such announcements?
Good morning to you too. Well, Greece is becoming an investment destination for a number of big giants and corporations such as Pfizer and Microsoft and Cisco and Blackstone in Volkswagen and NextEgo. So we expect more to follow as the political stability, the social cohesion, the economic recovery is taking place in Greece. And we look forward to materializing these amazing plans with Volkswagen and Ego and more to follow.
Why Asti Pelea for this island that they want to transform into this mega EV hub?
Well, the program is made up of 4 pillars. One is the pillar that has to do with renewable energy sources. So Asti Pelea is an island in the central Aegean that would run on diesel-generated energy. So we are converting that to a hybrid system that uses sun and wind and batteries, and that will cover the entire island. It's about 1,500 people. There is a certain living standard in the island. It is well represented in as far as both winter and summer residents and tourism of about 100,000 people a year. The second pillar is related to electromobility. So we are converting all of the combustion engines into electric vehicles with great support from the Greek government and Volkswagen. Third pillar is related to mobility on demand. So no more buses that go by every half an hour or 1 hour, but 24 hours a day, people call for an electric van to pick them up from wherever they are and take them to wherever they want to go to. And finally, we are going to be providing the needed infrastructure for autonomous mobility. So Asti Pelea is an island of the central Aegean that brings today a picture of the future.
And what about the government's focus for investments in energy, particularly renewables, broadly outside of these projects on this Aegean island?
We made a bold decision about a year ago to shut down all of our lignite plants in the country. So all of them will be shut down by 2023, with the exception of one that will be shut down by 2028. And we are very supportive of green energy, the Green Deal, and renewables. Renewables of all sorts, from sun to wind, and even offshore wind producing energy units. So we are truly converting the country into one place where electrification, electromobility, and renewable energy sources are going to play a significant role in the development of the country.
Is this due to the coronavirus pandemic? Is that why there has been such a big shift in renewables? As we go into 2021, what is the main focus of Greek economic diplomacy?
Well, the pandemic has caused tremendous suffering to the economy, not only in Greece, but all over the world. It's an unprecedented situation that we ran into. It had been, however, a reason to change a frame of mind in as far as how we conduct ourselves. We travel less, we use more of digital resources in doing business, in contacting each other, in maintaining social distancing, but also it has led to certain policy-making decisions in as far as governance is concerned. Just to give you an idea, hundreds of applications of digital transformation have been executed in Greece a little faster than one would expect it to. So in that respect, it has been of assistance to materializing our plans a little faster than what we initially thought. Now, in as far as our economy is concerned, tourism has suffered the consequences of the pandemic. We look forward to the moment that people will start traveling again and our tourism industry will grow as expected. But in the meantime, there is other sectors such as infrastructure and energy and renewables that we look forward to materializing. In as far as energy is concerned, we have big plants that are being materialized as we speak. Greece is becoming an energy hub in the region. We are putting together a floating storage and regasification unit in the northern part of the country, and natural depot of natural gas, a vertical corridor to our northern neighbors such as Bulgaria and Northern Macedonia, and eventually Romania and the rest of the Balkans. The Trans-Adriatic pipeline has been completed, and it brings Azeri gas from Azerbaijan all the way to Italy. So there is plenty of plans that are being materialized as we speak, and they do create an investment opportunity for big names and players to take part in it.
Right, and we see that with Volkswagen and Microsoft, and the Prime Minister said the Volkswagen project is a vote of confidence in Greece. My question, though, is, of course, we cannot forget the past. Will Greece fully recover from losses from its financial crisis?
The past is the past, and the future is what is awaiting for us, and we are here to implement new plans of economic restructuring, rationalizing our public finances, and boosting up our competitiveness in the country. We've done that successfully. Vaccination started yesterday. We look forward to the moment that the pandemic will be past. We expect that the tourism this coming season, this coming summer, will regain part of its glorious past. And we truly hope for the best in as far as the pandemic is concerned.
I think all of us do, and looking forward to traveling once again. Kostas Fragouyanis, Deputy Foreign Minister of Greece, thank you so much for your time this morning, that exclusive interview on Bloomberg Television this morning. Now let's get you up to speed with some of the other news this morning with our First Word News. President Trump has signed the $900 billion relief bill passed by Congress. He's backing down from demands that lawmakers change the bill before he sign it. The president is still calling for a vote to increase the $600 checks to $2,000, but that non-binding request is unlikely to pass. The UK is poised to approve the COVID-19 vaccine produced by AstraZeneca and the University of Oxford. Bloomberg sources say the regulator could clear the shot for use early this week. The Sunday Telegraph reports it could be rolled out from January 4th. Now, the UK has already vaccinated more than 600,000 people using the vaccine from Pfizer and BioNTech. And the European Union has begun a coordinated vaccination campaign less than a week after clearing the shot by Pfizer and BioNTech. It'll take months to vaccinate enough people to have an impact on the spread of the disease. But European Commission President Ursula von der Leyen says it'll be a gradual process, and caution, it is still needed. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Stay with surveillance, plenty coming up, including the Brexit uncertainty. The trade agreement may have brought some welcome relief to businesses, but the deal leaves major issues unresolved. We take a look at the implications for the UK economy next. This is Bloomberg.
No matter what, the UK's relationship with the EU is changing. Europe's 4 freedoms of movement will no longer apply from 2021. For Brits travelling across the Channel, you'll need 6 months on your passport and only be able to stay for 90 out of 180 days. Want to live and work? Well, the withdrawal agreement protects the rights of those already abroad, but to move in the new year, there will be new costs and residency requirements. Goods trade will see more friction. There will be new customs declarations, special certificates to move food, animals and plants, and you'll need the right paperwork to even get close to some UK ports. To avoid chaos, the UK is giving importers a 6-month grace period, but the EU is not following suit. There are changes for services and capital too, though a lot remains unclear. The City of London is set to lose its automatic right to sell into the EU. The UK has granted broad equivalence to EU capital, auditing and insurance, but Europe has been narrower, granting just temporary equivalence for UK clearing, and is in no hurry with other financial services.
The voice of Anna Edwards breaking down the Brexit negotiations. From finance to fish, the long-fought deal is raising questions across the board. After 4 years of negotiations, leaders announced an agreement on Christmas Eve, but it leaves some major issues up in the air, especially when it comes to financial services. Joining us now is Bloomberg's UK economy reporter, Lizzie Burden. Lizzie, what does the deal mean for the UK's economic growth, considering the fact that, as Anna really laid out there still remains a number of questions that we just don't have the answers to yet?
Yeah, good morning. Well, it's definitely better than having no deal. Bloomberg Economics had forecast that a no-deal scenario would have knocked off an extra 1.5% off output in 2021. And that's mainly because trading on World Trade Organization terms would have meant tariffs on many goods. But on top of just having a deal, the team predicts that the impact will be softened by a 5% COVID rebound in 2021, although that forecast was made before this mutant strain of the virus really took hold. But deal or no deal, there is always going to be more friction. As the Governor of the Bank of England, Andrew Bailey, put it, there's no such thing as a frictionless deal. And to give just one example, by the government's own estimate, almost 600,000 extra customs declarations are going to need to be filled out every day. And that's going to take up businesses' time and money to organise. So there's still a risk of disruption at ports. That could lead to food shortages at supermarkets. And we had a preview of that with the chaos at Dover when France shut down cross-channel traffic last week. And I was reporting from Dover. I saw that for myself. So Bloomberg Economics predicts that overall the new frictions will mean growth is 0.5 percentage points lower each year for the next decade than if the UK had stayed in the EU.
That's a lot more red tape, and the whole point, I believe, of Brexit was to try to get rid of that red tape and bureaucracy with the European Union. One thing potentially, the pound this morning still in the range of 135.48, not breaking out. Could a weaker pound end up helping, Lizzie?
Well, it could help by making exports cheaper, but you've got to remember that the uncertainty of the past 4.5 years has meant sterling never really fully regained its initial losses in the aftermath of the Brexit vote. And that uncertainty is also translated into weaker business investment, which in the UK has grown well below the levels in the US, Germany and France. And that's a problem that could get worse. A study by University College London and the London School of Economics forecast that foreign investment into the UK could drop 37% after Brexit. So a weaker pound really isn't some sort of Brexit panacea, even though some lead campaigners have been calling for the currency to be artificially devalued to boost the economy next year.
Very quickly, Lizzie, where does this leave the BOE?
Well, the deal definitely lessens the urgency for more emergency stimulus. But economists say that negative rates will be more likely if these strict lockdown measures continue past Easter. We had Monetary Policy Committee member Gertjan Vlieger telling Bloomberg this month that if the economic recovery slows in the new year, it could be time for negative rates. So just because we've got a deal, negative rates could still be on the table in 2021.
All right, our thanks to Bloomberg UK economy reporter Lizzie Burden there, who, as she says, was last week in Dover reporting on the scenes live of those trucks just mounting. Coming up on the program, we're looking at Bitcoin. Its rally continues, but will the momentum last? We're looking at what's next for the cryptocurrency market in 2021. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Welcome back. This is Bloomberg Surveillance. I'm Anne-Marie Hordern in London. Let's get a quick check on where we trade this morning when it comes to Bitcoin. The initial price of Bitcoin, set in 2010, was less than 1 cent. On Sunday, though, the world's largest cryptocurrency breached $28,000 for the first time before pairing some of the advance. Now, the digital coin has more than tripled in price in 2020. So the question going into the new year, can the cryptocurrency sustain its rally, or are we going to see a repeat of past Bitcoin bubbles? Across Assets reporter Eric Lam joins us for his take. Eric, good to catch up with you. Let's start there. Where do we see Bitcoin's price going next? I was really astonished by, we have low volumes between Christmas and New Year's, yet Christmas Eve to Sunday, it rose over 20%, breaching that 28,000. I mean, can this actually last?
Yeah, the funny thing with Bitcoin is that there's no market open and market close for cryptocurrencies. It trades 24/7 somewhere. And as you say, really spiked over the holiday weekend. I think there's probably, like there often is, a lot of discussion around dinner tables around that time about cryptocurrencies. And it was able to top that 28,000 level. We love round numbers, so the next level we're kind of looking at here is the 30,000 level, which is really astonishing thinking about from where we started at the beginning of the year. Talked to a source today who thinks that if we're looking at 30,000 likely might be a near-term top, but might not necessarily see the same kind of massive crash or sell-off that we did when the bubble burst in 2017. So we're talking maybe in the near term drops of maybe 10 to 15% rather than a really big crash like we did before.
What are people saying about longer-term outlook? Mike Novogratz on Twitter saying if it hits 5,000K by 2024, he's going to get a tattoo. I mean, is that likely, $5,000?
Well, you know, we keep talking about where's the top here, and then it keeps punching through those highs. It's done that repeatedly over the last month or so. So it's really, it's kind of uncharted territory that we're in now, and it's a dangerous game to try to put a pin on it or put a number on it at this point. I can point to a recent survey from Deutsche Bank. 40% of survey respondents expect Bitcoin to be higher next year in the range of $20,000 to just under $50,000. So that's a rough area of thinking about it. Another 12% actually see it crossing $100,000, which again sounds pie in the sky, but hey, we're talking about 30,000 now, and that's relatively within earshot. Considering again where we started the year of right around $4,000, suddenly doesn't sound so crazy.
What about other assets compared to Bitcoin? Everyone loves to compare it to gold. Manus calls Bitcoin the millennial gold. But gold right now is trading under 1,900. This summer it did very well, almost close to 2,100. How does Bitcoin compare with other assets? Just doesn't seem like any other asset can really keep up with the momentum that Bitcoin has.
Yeah, I mean, when you look at asset classes, certainly there's not really any real good comparison to Bitcoin. Gold is up about 25% this year, which pales in comparison to Bitcoin's almost 300% gain. Looking for gains like that, you're talking about individual stocks or speculative assets at that point. So it really has been a monster year for Bitcoin and for other cryptocurrencies as well. At this point of the year, we're winding down. We've seen it drop a little bit. There's still those kind of concerns about regulatory issues that are constant worry for cryptocurrencies. But longer term, again, one of the big changes from 2017 till now is that we have seen the entry or the start of entry of the institutional investors, and that has made a difference from back in 2017.
All right, our thanks to cross-asset reporter Eric Lamb. That does it for me in Bloomberg Surveillance. Guy Johnson will continue the program coming up in the next hour. This morning, we do have equities moving to the upside, starting the final week of 2020 with a gain. That does it for me for 2020. See you next year. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Stocks jump as Trump signs the virus relief bill, while a government shutdown has been avoided by waiting until late Sunday night. The president deprived around 14 million Americans of 1 week of unemployment aid. In terms of what is happening here in Europe, the big focus now on vaccines. Europe starting its rollout of its vaccine program. It's using the Pfizer-BioNTech vaccine. However, here in the UK, there is an expectation growing that within the next few days, we could see an approval of the AstraZeneca-Oxford vaccine. That can have a big impact on the UK economy. And in terms of what else we're watching, a continued focus on what is happening with the markets. And out in China, Alibaba shares under a great deal of pressure. Jack Ma's Ant Group told by Chinese authorities that its business model needs to change. This raises the risk of a breakup. The whole Chinese tech sector, could it be at risk? Well, today, that sector is certainly seeing a significant sell-off. Good morning, everybody. Monday morning. This is Bloomberg Surveillance. I'm Guy Johnson. Francine Lacroix and Tom Keane both have the day off. Let's continue to update you on what you need to know. Here with the First Word News is Radhika Gupta.
Morning, Guy. President Trump has signed the $900 billion coronavirus relief bill passed by Congress. He's backing down from demands that lawmakers change the bill before he sign it. The president is still calling for a vote to increase the $600 checks to $2,000, but that non-binding request is unlikely to pass. The UK and the EU have finally signed a post-Brexit trade deal, but speaking to the Sunday Telegraph, Prime Minister Boris Johnson admits it doesn't go as far as he wanted on financial services. There's still little clarity on so-called equivalence that allows non-EU firms to sell their services into the EU single market. And the internet empire of billionaire Jack Ma is facing increasing pressure from China. Regulators are telling his financial firm Ant Group to go back to its roots as a provider of payment services. It's threatening to throttle growth in its lucrative business of consumer loans and wealth management. Ant says it's creating a special team to set up a timeline for the overhaul. Global News 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Radhika Gupta. This is Bloomberg. Guy.
Radhika, thank you very much indeed. So the UK market is closed today. There is a national holiday here in the UK, as a result of which we are seeing light volumes across Europe. But let's see what markets are doing. Continental markets are open. The DAX hitting an intraday record high a little bit earlier on in the session. Part of that's down to what is happening with Delivery Hero. It's having a solid day today, but also I think some Brexit relief for the German industrial sector, particularly the autos. The dollar is, though, down on that relief bill signing by the president. We'll talk about that in a few minutes' time with an FX specialist from Commerzbank. S&P futures largely bid at the moment, so I think we're going to see a positive open over in the United States in terms of where we sit with the fair value right now. The S&P up a little more than the futures, up by around 0.7% once you run the full calculation. And Bitcoin, we've got a 26 handle. We have had a 28 handle. We've seen huge moves over the last few days. It doesn't seem as if Bitcoin stops for holidays. It trades 24/7, and as a result of which, I think some volume piling in as people enjoyed those holidays and focused what was happening with the Bitcoin trade. But as you can see, another big move. We're up by 9.66%. Let's return now, though, to what is happening with politics in D.C. and Mar-a-Lago, for that matter. President Trump has signed the $900 billion pandemic relief bill. The back down from the president at the last minute, late Sunday night, basically caving in to demands to get it done, to avoid a government shutdown, and to get those all-important checks out to people and the unemployment benefit to start flowing. Joining us now to give us a sense of what happened and what is going to happen next is Bruce Einhorn. Bruce, let's talk a little bit about what happened here. Why did the president finally decide to sign on the dotted line?
Well, nothing really has changed between last week when he said that it was a disgrace and that the $600 payments were ridiculously small. And now when he signed the bill, the bill is the same. But as you pointed out, the pressure was building. There are a lot of worries among Republicans that this is really going to cost cost them control of the Senate with the two runoffs in early January, and the two Republican candidates really getting hammered because of this.
Absolutely. Just in terms of people's lives, 14 million Americans basically have missed out on a week of enhanced unemployment benefits. Can we just kind of calculate the impact at this point in terms of the effect that that is going to have on the U.S. economy?
Yeah, that is a very good point, because Congress passed this with a hard deadline for when the additional unemployment benefits expire. The delay by the president in signing the bill means that 1 week gets shaved off of that. That week doesn't get added at the back end, so that's 1 week gone. So this comes at a time when the economy is weakening and coronavirus cases are soaring. So there's a lot of pain across the country.
Bruce, final quick question. The president basically has decided that he is going to take a different approach to the Republican Party. Is this the beginning of a split between the president and the Republican Party? And what long-term implications could that have?
Well, that's a good point. It certainly seemed that way last week when Trump first came out with his opposition to the bill. Around the same time, he was dismissing the number 2 senator from the GOP caucus, John Thune, as, quote, Mitch's boy, and called for a primary against him in 2022. And the call for $2,000 relief checks also seemed like it was a real slap at McConnell and the Republicans, because so many of the Republican senators were dead set against that. The fact that now Trump has signed the bill, maybe that's an indication that he's backing down from this fight. I mean, we still have to see.
Yeah, I think it's going to be fascinating to see that one play out. As you say, though, probably the near-term focus, what is happening in Georgia. Bruce, thanks for the input. Greatly appreciated. Bruce Einhorn joining us on the latest in terms of the politics out of D.C. Joining us now to assess the market implications of all of that, Thu Lan Nugent, Commerzbank FX strategist. Let's talk a little bit, good morning, by the way, and thank you for joining us. Let's talk a little bit about why the dollar has gone down as a result of the president signing this. Why is this dollar negative?
Well, actually, the reaction of the dollar was in line with what we've seen over the last couple of months. The dollar has been reacting negatively to the prospect of further U.S. fiscal stimulus because I believe that the market is looking through the positive economic effects of this deal in the short to medium term and is focusing more on the longer term implications of this deal and the deals that we already had, which are pushing up U.S. debt significantly. And this obviously has long-term implications. But obviously the question is how this debt will be reduced? Can it be stabilized in the longer term? And what we are seeing, which is quite interesting, is that in line with the outlook for further fiscal stimulus, inflation expectations have been rising in the U.S. If you look at five-year inflation expectations, they are at the highest level for at least 2 years, I believe. And so the market is seeing inflationary risks because of this fiscal stimulus. This obviously is negative for the U.S. dollar because the Federal Reserve has changed its strategy this year and is saying that it wants inflation to overshoot for some time before it will raise interest rates. So with rising inflation expectations, real interest rates in the US are going to fall. And this, in turn, is negative for the US dollar.
Okay, so that's one side of it. And I was kind of hoping that that would be the argument you would lay out. My question now is, do we get to a point where actually the other side of the dollar smile starts to have an impact on the market as well? Normally, you run to the dollar when things are looking particularly bad, and you run to the dollar when things are looking particularly good. Now, we kind of saw the running to the dollar earlier on in this crisis. We're now at the point, as you say, where kind of relative interest rates on either side of the Atlantic or relative real yields on either side of the Atlantic have kind of come into balance. But now I'm wondering kind of who comes out of this crisis best. And I wonder whether it's going to be the US economy, and at some point whether or not that starts to get priced into the dollar and we see a reversal of the move that we're getting at the moment, potentially quite a big reversal of the move as the US economy powers out of this crisis in a way, for instance, the European economy might not.
That is indeed one decisive factor, one decisive driver. And the biggest risk to our dollar forecast, we are rather dollar bearish because of the outlook for declining US real interest rates. But indeed, in economics, there's one effect that's called the Penn effect, which basically puts GDP in line with exchange rate movements. That is, economies which are more wealthy, which have higher GDP levels, usually have a stronger currency. And obviously, the effect that you're talking about, who will recover from this crisis faster, this will have an effect on the exchange rates. At this point, however, uncertainty is quite high. Who will really recover faster? And we've seen over the last year that US had some issues handling the crisis. The EU certainly as well had issues handling the crisis. And at this point, it's unclear. And therefore, we did not factor this into our dollar forecast. But should it turn out that the US economy recovers much faster than the Eurozone, then that certainly would be a positive factor for the dollar. If we would see an entire reversal of the dollar weakness that we've seen over the last year, I'm not sure about that. That certainly depends on the pace of the economic recovery we would see. But it cannot be excluded entirely, sure.
One other factor comes to mind here that could change the calculation regarding who will come out of this crisis first and better, and that is the rollout of the vaccine. How much attention are you paying to how quickly and how effectively the various regions are rolling out the vaccine? At the moment, it's largely the kind of the Moderna BioNTech sort of race, the Pfizer-BioNTech Moderna race, but we're likely to see J&J's vaccine coming through. We could get the Astra vaccine very soon as well, and that could change that calculation. How big a factor is this in terms of your calculations regarding where currencies go?
It is a big factor because at the moment we forecast that the Eurozone economy in the second half of next year will recover quite significantly. And this will also provide a boost to the euro. But should we not see that post-vaccine recovery, that would obviously really would be a downside risk for our current euro exchange rate forecast. And what is worrying us at the moment is that so far the EU has only ordered a vaccine for about half the population of the European Union. And so this puts our call at risk that we will have herd immunity by autumn or winter next year. And this could obviously hamper the economic recovery to some extent. But at this point, we remain quite confident that as soon as we have that we have the start of the vaccine program, and at least a significant portion of the population is already immune. This will at least avoid any further lockdowns, which would be detrimental for the economy. That by itself is already an economic, a positive economic effect that we should be seeing next year.
Yeah, you do wonder whether the new variant may cause actually herd immunity, the number of the percentage of the population to be higher, which is going to be an interesting calculation as we work our way through this year. So stay with us. Thula Nguyen, Commerzbank FX strategist, staying with us. Up next, we'll come back to the issue of Brexit. We'll talk more about the impact there. We're also going to be talking later on the show with James Lucier, Capital Alpha Partners, senior political analyst. That conversation, 5:30 a.m. in New York, 10:30 a.m. here in London. This is Bloomberg.
we have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need is surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
No matter what, the UK's relationship with the EU is changing. Europe's 4 freedoms of movement will no longer apply from 2021. For Brits travelling across the Channel, you'll need 6 months on your passport and only be able to stay for 90 out of 180 days. Want to live and work? Well, the withdrawal agreement protects the rights of those already abroad, but to move in the new year, there will be new costs and residency requirements. Goods trade will see more friction. There will be new customs declarations, special certificates to move food, animals and plants, and you'll need the right paperwork to even get close to some UK ports. To avoid chaos, the UK is giving importers a 6-month grace period, but the EU is not following suit. There are changes for services and capital too, though a lot remains unclear. The City of London is set to lose its automatic right to sell into the EU. The UK has granted broad equivalence to EU capital, auditing and insurance, but Europe has been narrower, granting just temporary equivalence for UK clearing, and is in no hurry with other financial services.
Bloomberg's Anna Edwards looking at the 4 freedoms, the free movement of people, goods, services and capital, and how they're likely to change now that the UK is going to be leaving the EU's single market with a deal. But remember, that doesn't cover services. Still with us, Tulan Nguyen, Commerzbank FX strategist. Tulan, let's talk a little bit about the pound. We're at session lows right now, 135.28 on the cable rates. Are you surprised by the muted reaction we've seen from foreign exchange markets to this deal?
Maybe a little bit. We would have expected at least more significant relief rally in sterling exchange rates. But we were always very cautious in forecasting a rally in the pound anyways. We always pointed to the fact that the appreciation potential was limited because you have to remember that the deal that we have now 3 or 4 years ago, after the referendum, this was considered to be a hard Brexit. Obviously, this term changed when it was clear that the UK did not want to remain in the single market and it did not want to remain in the customs union. But it still is a relatively hard Brexit, which will introduce frictions in the trade between the EU and the UK. And obviously, this means that despite the fact that this is better than a no deal, certainly, it is not the best case that we had envisaged maybe 3 or 4 years ago. And so obviously, because of this, the appreciation potential of the pound is quite limited.
Tulan, where we have seen a significant move is in pound volatility trades. Do you think that's an opportunity? Do you think there's a buy there? Because my sense of this deal is that basically what it sets up is a ongoing negotiation And there's still so much still to be decided. Financial services is obviously a huge area that remains undecided at this stage. Do you think if volatility were to fall even further, that would be a buy because there are going to be many bumps in the road?
I think so. I think there are still a lot of questions which remain unanswered. Already been mentioned now plenty in the media, such as obviously what is the future for services trade between UK and the EU, for example. And there are still a lot of stumbling blocks, certainly also in the implementation of the trade deal that was just agreed on. And so, yes, I would expect pound volatility to remain relatively high because there are still some setbacks that we could see. And it's uncertain how the UK economy will now fare with this trade deal. It could obviously be better than expected. That's clear. And we could see a sterling rally if the UK economy fares relatively well in the next couple of quarters. But it could obviously also be the opposite. So as long as uncertainty is this high, I would consider, or I would say that pound volatility should remain relatively high, and a significant decline in pound volatility would not be justified.
Tula, we're going to leave it there. Thanks very much indeed for your input this morning. Thank you very much indeed for joining us. Tula Nguyen, Commerzbank FX strategist. We'll continue the Brexit theme a little bit later on. Robin Niblett, Chatham House director, is going to be joining us. We'll get his take on what exactly this deal means for the British economy and further trade deals. That conversation coming up 6:30 a.m. in New York, 11:30 a.m. here in London. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Monday morning, this is Bloomberg Surveillance. I'm Guy Johnson. I'm in for Francine Lacroix and Tom Keane. Both have the day off. Well deserved. Let's talk about the markets. London has the day off as well today. It is closed. We are seeing light volume as a result across Europe. Things will pick up again tomorrow. The pound is trading and is at session lows. The Bloomberg Dollar Index is also tracking lower as well. This after the president signed the relief bill late Sunday. The DAX hitting an intraday record high earlier on today. S&P futures broadly bid. Bitcoin continues to be bid as well. Bonds, though, are selling off. What do we got for you next? James Lucier, Capital Alpha Partners, senior political analyst, is going to be joining us. We're going to find out why the president finally signed on the dotted line late last night and what the impact of his delay is going to have on the US economy. That's coming up. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Bloomberg Surveillance, I'm Ritika Gupta with your Bloomberg First Word News. The UK and the EU have finally signed a post-Brexit trade deal, but speaking to the Sunday Telegraph, Prime Minister Boris Johnson admits he doesn't go as far as he wanted on financial services. There's still little clarity on so-called equivalence that allows firms to sell their services into the EU's single market. The UK is poised to approve the COVID-19 vaccine produced by AstraZeneca and the University of Oxford. Bloomberg sources say the regulator could clear the shot for use early this week. The Sunday Telegraph reports it could be rolled out from January the 4th. The UK has already vaccinated more than 600,000 people using the vaccine from Pfizer and BioNTech. The European Union has begun a coordinated vaccination campaign less than a week after clearing the shot by Pfizer and BioNTech. It will take months to vaccinate enough people to have an impact on the spread of the disease. European Commission President Ursula von der Leyen says it will be a gradual process and caution is still needed. Global News 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy.
Ritika, thank you very much indeed. Let's turn to what happened overnight in Asia. Chinese regulators have ordered Jack Ma's Ant Group to overhaul its business model and basically return to its roots as a provider of payment services. Ant says it will set up a special team to comply with the demands. What does this ultimately mean, though, for this business going forward? Our Asia investing editor, Lulu Chen, joins us now. Lulu, let's start with Ant. What exactly does the PBOC want?
China's central bank has told Ant to re-examine its fintech business, saying that it needs to realize the necessity of overhauling its business. Right now, the ball is with Ant. It needs to come up with a plan and a timetable and take that proposal to China's regulators to be greenlit. For the company, the regulators stopped short of saying that it needs to break up the company. So on that front, that's a good sign. Investors and analysts expect that the company might need to come up with, realistically, it might need to come up with a proposal to offload some of its assets and wealth management and also credit consumer lending into this financial holding company that would most likely be regulated more like a bank going forward. And that means crippling growth for some of its biggest revenue drivers. I'm
looking at Baba now, Lulu. It's down by around 1.72%. This is the pre-trade in Alibaba over in the United States. It gaps lower sharply on the back of this news, though. What is the risk to Baba here?
For Alibaba, their trouble is that the Chinese anti-monopoly regulator is now launching an investigation into the company. They concluded their on-site investigations on Friday, and people are waiting to hear what the results and the scope of damage that the company is facing. The anti-monopoly crackdowns, I have to note, though, is not just targeting Alibaba. It is an industry-wide target, though Alibaba being the largest e-commerce company in the sector does make it a high target profile.
Okay, you talk about being the whole potential tech sector or the whole internet sector in China. There was a more widespread sell-off on that risk today. How seriously should we be taking that risk? Is this just the beginning of the Chinese authorities deciding that this sector has become too high profile and as a result of which needs to be knocked down a little bit? Is that a significant risk for the entire sector?
Well, that's a really good question and what investors really want to hope to find out, because the regulators have not been very transparent in terms of what their actual intentions are, apart from saying that this is to protect consumer rights and maintain financial risks. The concern is that some are saying this is a watershed moment where the Chinese government has largely left China's internet companies alone, and that's one of the reasons they've been able to grow so big over the past 2 decades. And this is the watershed moment where things are going to change and the iron fist is going to come down. The optimists would say that this is pretty much like the previous regulatory clampdowns that have made the companies take a hit in terms of valuation in the short term, but the largest companies like Tencent and Alibaba going through this in the past have come out unscathed largely. So right now, people are trying to figure what that actually, this round of regulatory clampdowns actually mean.
Yeah, absolutely. And whether or not, as a result, people are going to be investing as much money into this sector, particularly US investors, I'm hearing quite nervous about what is happening here. Lily Chen, Bloomberg's Asia Investing Editor, greatly appreciated. Thank you very much indeed. In the next hour, we're going to get back to politics stateside. Sharon O'Halloran, Columbia University professor of political economy, joining us in the next hour. That's about 6:30 a.m. in New York, around 10:30 a.m. here in London. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Good morning, welcome. This is Bloomberg Surveillance. I'm Guy Johnson, Francine Lacroix, Tom Keene. Both have a well-deserved day off. So let's talk politics now. President Trump has finally signed the $900 billion relief deal put forward by the US Congress, basically avoiding a government shutdown as well. While signing the bill, Trump demanded a vote in Congress to increase the $600 stimulus checks that are going to go out to $2,000. It's basically a non-binding request, and as a result, at least for the time being, it's unlikely to pass both chambers, particularly the Senate, an issue there. Joining us now to discuss all of this, James Lucio, Capital Alpha Partners senior political analyst. James, why did the president blink?
Well, number one, there's no explaining Donald Trump ever. Number two, he's got a track record of changing his mind at the last minute. The last government shutdown we had in 2019 was the longest shutdown ever. Trump was refusing to sign funding for the government unless he got funding for his border wall. Eventually, though, I think that he decided that he had sent his message, and he did relent on January 25th, 2019. Finally, of course, unemployment benefits for many people expired that day, as did many people with their protections from evictions and so forth. I think that on net, President Trump decided that he didn't want to see people completely losing their support and being evicted in the Christmas season. But the bottom line, I think, is that Trump has sent his message. People know he wanted $2,000 checks. He owns that issue. And he's basically done what he needed to do to to, I think, take command of the situation, at least in his own mind. The thing about Trump is that you never watch what he says, you watch what he does. And in this case, he's shaken things up, but not flipped the table over at the end of the day.
What impact will this have on Georgia in a few days' time?
Well, the Georgia races are important because control of the U.S. Senate is at stake. Republicans are generally favored there for a lot of reasons, primarily because Republicans got more votes at all levels of government other than in the presidential race, and even there it was close. But I think there was a real risk that Trump's demand for a $2,000 check per person would have undercut the two Republican candidates who had voted for the $600 per check. And also, of course, Trump was mounting an attack on what he saw as the corrupt Republican establishment in Washington, appealing to his base against that establishment. And both the Republican candidates in Georgia are effectively members of said establishment. So while Republicans have had an edge in holding on to those two seats, it was very possible, it still is possible, they could lose both, in which case Joe Biden will, contrary to current expectations, have a chance to implement really the greatest part of his agenda with regard to energy, clean energy, that is, infrastructure, healthcare, and of course, stimulus.
I want to come back to the split between Trump and the Republican Party in just a moment, but let's just talk about Georgia for a moment more. You said it's very tight. What is your kind of reading of the tea leaves and the political polls right now? I know we've learned not to trust them, but what is your assessment?
Well, I think that we've learned not to trust the polls at all on the state level, given the experience of this presidential election cycle. Pollsters have told us that, oh, if 1%, 2%, 3% of the people that answer the telephone are a valid sample, that they're not biased in some way, the polls are accurate. In fact, we just don't know. Likewise, the fundraising, I mean, Democrats are outraising Republicans substantially here. We thought that would be a factor in the last election, but it really wasn't. I think the best predictor of how people vote is how they've predicted and how they've voted in the past. And so I think that based on the actual voting in the last election cycle, Republicans do have an edge here. But I regard the situation as really opaque. I don't think the polls or some of the other metrics we're seeing, like voter registrations or absentee ballot files, really tell us much, if anything.
James, let's get back to this split between the president and the Republican Party. Is this just sour grapes that the Republican Party has not done more to support President Trump in his battle to win re-election and his frustration that he hasn't? Or is this something more? Is this the start of the sort of the Trump political party, the fracturing of the right? You still wonder whether or not the president has eyes on the next electoral cycle and whether or not he still feels that he has one more shot of this. And you do wonder whether or not this is kind of the beginning of that, the firing of the starting gun on that process, this split over the last few days.
This is absolutely the first move of Trump's post-presidential future, whether he's running in 2024 or not. And at this point, I believe he is running. He's gone on record as being in favor of the working class. Secondly, you've got to remember that Donald Trump has more in common with Bernie Sanders and Olivia Ocasio-Cortez than most people think, or I should say Alexandria Ocasio-Cortez. Both these wings, the Democrats and the Republicans who critique the establishment, see Washington as dysfunctional and unable to move on key topics. And, you know, Trump's critique of this bill, it's 5,000 pages long, and it took months to produce, and ultimately it gives you a measly result from the perspective of working class Americans. Trump sees this as an indictment of the current system, and there are a lot of people on both the left wing of the spectrum and the right wing of the spectrum who think the system is broken.
If the Democrats were to win in Georgia and you were to see an unleashing of the Democratic Party spending agenda and potentially a bigger voice for the left of the party because the opportunity would be there, How much would that undercut that Trump argument? As you say, in some ways, you come full circle, back to Sanders, back to AOC. But if the Democrats can deliver that agenda and bring the working class vote back to their party rather than leaving it on the Trump side of the ledger, does that kind of undermine and undercut the Trump case going forward?
I think it could, to large measure. You've got to remember that the Democrats have at their disposal budget reconciliation rules, so that even with 50 votes plus one, we would probably see significantly more spending, more fiscal impetus, probably on the order of I would say on the order of $5 to $7 trillion over 10 years, front loaded. That's what we expected if Democrats won a presidential Senate majority. They would get a stimulus bill. They would get an infrastructure bill. They'd get a clean energy or Green New Deal type bill. They could do an awful lot of that, as opposed to the current outlook, which is probably just one big effort by Joe Biden early in the year. And that would be a single bill that does the best that he can do under current circumstances on stimulus, on COVID, on healthcare and green infrastructure.
James, let's come back. Let's assume that we end up with divided governments. We don't know what's going to happen in Georgia, but let's just assume that for the moment. That early effort by the Biden administration, is it going to look very similar to the relief bill we've just seen, with a little bit more of a green agenda and a full focus on that $2,000? Is it basically a kind of cookie cutter process? We're going to focus on those two key aspects. We're going to change the mix a little bit. But basically, we've seen that this works and we can continue with this.
No, I think that Biden needs to take advantage of the post-pandemic crisis, if you will. If this is the dark winter of COVID, things that will get worse before they get better. I think that Biden needs to take the opportunity of that moment and put a large COVID stimulus combined with the infrastructure package he wanted to do, or some semblance of that. It would be based on a normal highway bill. He would green it up. In other words, he would use the need to pass something urgently to deal with the pandemic and also the economic slowdown caused by the pandemic. And that would be Biden's single greatest opportunity to do as much of his agenda at once as do as much as possible. So that would be something much bigger and much broader than we see in the current bill. It would be a broader spectrum of things, but it would still be a relatively smaller subset of the things that Biden campaigned on.
Just final quick question, James. It's an important one, I think. By delaying until Sunday, the president has effectively denied around 14 million Americans of unemployment benefit, unemployment aid. What are the implications of that? And do you think we're sort of underplaying just the economic pain that this has caused?
Well, I think there is quite a lot of economic pain there. I think that may be the factor at the end of the day, while the president finally relented. He had made his statement, but didn't want the bad press from denying those benefits. We do have a Biden administration coming in. It's likely that there will be more in the spring. But I think that the president, by making a statement and then finally deciding to sign the bill, is at least allowing something to happen. We're turning the page and moving to the next chapter.
James, really appreciate your time this morning. Thank you very much indeed for sharing it with us so early and setting us up for the week. James Lucia, Capital Alpha Partners Senior Political Analyst. What have we got coming up for you on the Simplecast? Kathy Jones, Chief Fixed Income Strategist. That conversation, 8 a.m. in New York, 1 p.m. in London. This is Bloomberg.
型にはなんと2万点以上、前進でついてます。なので2万点あることにより、その情報が取れない、平面がないんですね。なので全てをスキャンすることができるので。どちらにせよ自分のサイズを1回最初から、適正なものを発見してそれを買って、家に届いてきたらぴったり非常にハッピーというのがやっぱりしかるべき姿かなと思ってます。
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
This is Bloomberg Surveillance. I'm Rishka Gupta with your Bloomberg Business Flash. US holiday sales have risen by 3%, driven by a boom in online shopping. According to MasterCard, it's much better than the result during the last recession in 2008, which saw a 3.5% drop. Online sales rose a whopping 49% from a year earlier. E-commerce now accounts for a fifth of all dollars spent in the holiday season. South Korea is ordering Delivery Hero to sell its local unit before it can take over the country's largest food delivery firm. The regulator said the merger of the first and second largest platforms in the country could lead to higher fees for restaurants and hurt customers. Together, they'd have an over 99% share of the market. And BMW plans to build an additional 250,000 electric cars in the next 3 years. The car maker's CEO says sales of electric vehicles will account for about a fifth of BMW's sales by 2023. That's up from around 8% now, but he's concerned that Germany's transition to e-cars may be hampered by the lack of charging infrastructure. Billionaire Elon Musk said it would be impossible to take Tesla private. The comment came in response to a tweet calling on him to spend more time on innovation. Tesla shares have surged 8-fold this year ahead of its addition to the S&P 500. That's twice the advance of the next best performer on the index. Deutsche Lufthansa has cut costs more quickly than expected this year. The German airline's boss says the company is not in danger of slipping too far into debt. He told a German newspaper it has about 10 billion euros of available liquidity, and it's only tapped a third of the 9 billion euros it borrowed from European governments and hasn't spent much of it. And that is your latest Business Flash, Guy.
Rebecca, thank you very much indeed. Let's get back to the stimulus package that has now been signed. Former Treasury Secretary Larry Summers spoke on Wall Street Week about the relief deal.
We're better off with stimulus than we are without stimulus. I don't think the $2,000 checks make much sense. The real issue is going to be sustaining this expansion. If you think about it, the 908 stimulus bill probably would pay out $200 to $250 billion a month for the next 3 months. The level of compensation is running about $30 billion a month below what we would have expected it would. GDP is running about $70 billion a month below what we would have expected it would. So in a way that's quite unprecedented, we have stimulus already much more than filling out the hole. And given that lots of the hole is from the fact not that people don't want to spend, but that they can't spend because they can't take a flight or they can't go to a restaurant, I don't necessarily think that the priority should be on promoting consumer spending beyond where we are now. So I'm not even sure that I'm so enthusiastic about the $600 checks. And I think taking them to $2,000 would actually be a pretty serious mistake that would risk a temporary overheat. I would like to see more assistance to state and local governments. I would like to see more money put into testing. more money put into accelerating vaccines. But gosh, David, I think it would be a real mistake to be going to $2,000.
Former Treasury Secretary Larry Summers speaking to David Weston on Bloomberg's Wall Street Week. A few headlines coming through. A German government press conference within the last few minutes, revealing that the German cabinet has backed the EU-UK trade deal. That's according to a spokeswoman. Markets generally bid from an equity point of view. We're seeing that on both sides of the Atlantic. Remember, London is closed today, so light volumes. The dollar is going down. Bitcoin, well, it continues to climb. Much more to come in the next hour of surveillance. This is Bloomberg. So stocks jumping as Trump finally signs the virus relief bill, while a government shutdown has been avoided as well by waiting until Sunday night. The president basically depriving around 14 million Americans of 1 week of unemployment aid. That is a big deal. Europe starting to vaccinate. It's using the Pfizer-BioNTech shots. The UK government is expected to approve the AstraZeneca-Oxford vaccine within days. And Alibaba shares sinking as Chinese authorities tell Jack Ma's Ant Group to revamp its business model, raising the risk of a breakup. Is the whole Chinese tech sector now at risk? Good morning, everyone. This is Bloomberg Surveillance. I'm Guy Johnson. I'm in London. I'm in for Francine Lacqua and Tom Keane. both of which have a well-deserved day off. Let's check all the headlines that you now need to know about. Here's the Bloomberg First Word News. Here's Radhika Gupta.
Thanks, Guy. President Trump has signed the $900 billion relief bill passed by Congress. He's backing down from demands that lawmakers change the bill before he signs it. The president is still calling for a vote to increase the $600 checks to $2,000, but that non-binding request is unlikely to pass. The UK and the EU have finally signed a post-Brexit trade deal, but speaking to the Sunday Telegraph, Prime Minister Boris Johnson admits it doesn't go as far as he wanted on financial services. There's still little clarity on so-called equivalence that allows non-EU firms to sell their services into the EU's single market. And the internet empire of billionaire Jack Ma is facing increasing pressure from China. Regulators are telling his financial firm Ant Group to go back to its roots as a provider of payment services. It's threatening to throttle growth in its lucrative business of consumer loans and wealth management. Ant says it's creating a special team to set up a timeline for the overhaul. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Radhika Gupta. This is Bloomberg. Guy.
Radhika, thank you very much indeed. Let's talk about what is happening with the markets this Monday morning. Remember, London is closed for a national holiday. You are seeing light volumes here in Europe as a result of that on the equity front. In terms of what we're seeing, though, we're seeing a weaker dollar, though it is starting to come off the lows. In fact, it's very much off the lows. What we are seeing is the pound under pressure today, 134.93, maybe better to travel than arrive. The deal has been done, as we were just hearing from Radhika. But nevertheless, we are seeing weakness in sterling today on the cable rate. The Norwegian kroner under a little bit of pressure as well. We're watching what is happening with the oil market. The euro is, though, trading up just off session highs, up by 0.2%. The DAX hitting an intraday record high a little bit earlier on in the day. But I have to caution again, it is on light volume. London is closed. We are seeing a Brexit effect there, the industrial sector benefiting, but also Delivery Hero having a strong day. US futures broadly positive as well. We're up by around 0.7%. And the Bitcoin story continues. We've been up to 28,000. Are we going to get to 30,000? Well, at the moment, we're at 26,000. We're going to keep an eye on what is happening here. We've also got some breaking news over the last few minutes from the European banking sector. We'll talk more about the European banking sector a little bit later on in the day with Hugo Rogers. But Commerzbank over the last few minutes confirming that it's going to book an extra 610 million euros in restructuring provisions. This as it slims down the bank. Remember, a huge impact here in terms of the retail side of that institution as it basically tries to cut its way to growth. The stock, as you can see, near session lows, down by 0.6%. We are going to be talking politics a little bit later on in the show. Huge moves, obviously, late Sunday with the president signing the bill. Sharon O'Halloran, Columbia University professor of economics, professor of political economy, joining us. That conversation, 6:30 a.m. in New York. That translates to 11:30 a.m. here in London. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
No matter what, the UK's relationship with the EU is changing. Europe's 4 freedoms of movement will no longer apply from 2021. For Brits travelling across the Channel, you'll need 6 months on your passport and only be able to stay for 90 out of 180 days. Want to live and work? Well, the withdrawal agreement protects the rights of those already abroad, but to move in the new year, there will be new costs and residency requirements. Goods trade will see more friction. There will be new customs declarations, special certificates to move food, animals and plants, and you'll need the right paperwork to even get close to some UK ports. To avoid chaos, the UK is giving importers a 6-month grace period, but the EU is not following suit. There are changes for services and capital too, though a lot remains unclear. The City of London is set to lose its automatic right to sell into the EU. The UK has granted broad equivalence to EU capital, auditing and insurance, but Europe has been narrower, granting just temporary equivalence for UK clearing, and is in no hurry with other financial services.
Anna Edwards, looking at the 4 freedoms that effectively the UK is now no longer a part of, movement, people, goods, services and capital. They are going to change. Well, we don't know how much they're going to change. It'll be interesting to see now that the UK has left the EU's single market. So we've had that done. Brexit, in theory, for the time being at least, is now done. That's one political issue that is off the table for the market to worry about. The other one is that we've seen the president signing the relief bill late Sunday. That's another risk in the short term that has been taken off the table as well. In terms of what that means for markets, well, let's figure that out. Hugo Rogers, Deltec Chief Investment Strategist, joining us now. Hugo, thanks for joining us. Greatly appreciate your time. Look, for the moment, we have seen 2 big factors in terms of political risk removed from the market, but there is likely to be significant political volatility into 2021. How big a discount do you think we need to apply for political risk, and where do you see the big challenges coming from?
Well, I think the most obvious first risk is the Georgia state elections. So if there is a sweep, if Biden actually does get his majority, which is obviously the 50+1 with the vice president, then you have a completely different political and an economic landscape, an opportunity for the Democrats to bring in very significant, not only stimulus, but changes in the tax, the tax code as well. So the very first political risk is Georgia. And then you have the slow reveal of Biden's political agenda, regardless of that outcome. So those are the 2 first risks. Beyond that, I think the most important political risk, actually, Brexit done. We can talk about that if you like, but China, the struggle between China and the US, that is going to continue, and it's a multi-year phased skirmishes followed by some very significant differences of worldview, which we're going to see play out over a number of years.
We've also got the Angela Merkel era coming to an end. That's going to be a factor that I think Europe is going to ultimately have to deal with. And then we need to factor in the impact of vaccines and the kind of differing speeds at which they're all going to work. essentially, there's still a lot to talk about and a lot of to think about as we go into 2021. I got a VIX at 21.74 right now. By historic standards, that remains relatively elevated. Volatility is going to be something that I think investors are going to have to deal with throughout 2021. What strategies do you think are going to work best in a more volatile environment, in a higher VIX environment?
Well, I mean, sorry, the guy that presupposes the VIX is going to stay this elevated. If there is actually a vaccine-led revival, which you alluded to, then there's a distinct possibility that volatility might actually subside over the course of 2021. So what we always discuss at Deltec and talk to clients about is revival equals rotation. So the value underperformance over a multi-year period has been so substantial that actually that's where the release valve can come in. If we do get a revival, we can get some kind of cyclical recovery. And while we're in this Goldilocks period where you not only have the potential of a growth recovery and stimulus from both central banks and from government, you can get into a situation where you're getting waves of rotation and cyclical recovery, and that could actually even see the VIX fall for a period over the next year. Now, where it can rise is if that whole setup unleashes the inflation beast that people have been talking about for a period of time. It's not something that we actually are too worried about yet. But we do know that that low volatility really is very closely correlated with low interest rates. So if interest rates start rising again because of inflation, that could be your next bout of volatility. So perhaps lower from the VIX first, and then watch out for that inflation monster if it gets released.
Do you think if we were to see some kinds of inflation, and it really sort of depends on which kind of inflation we get, demand pull, cost Indeed. Push. Do you think the Fed would sit on any kind of steepening of the yield curve? We've got yields that are just shy of 1% stateside on the 10-year right now. If that was to rise to, say, 1.5%, do you think the Fed would react?
I think actually the Fed wants the steeper yield curve. It's openly said it actually would like to exceed its inflation target. This inflation targeting program they put in place is actually designed to effectively steepen the yield curve. So yes, I think they would allow it up to 1.5, but they must be at that point start to be very wary that that the steepness is actually going to have some sort of tightening effect on financial conditions and actually unwind some of the good that they've done over the last year. So so initially, yes, they would live with it, but if it steepened too much too fast, they might worry that you might have some problems in the bond market, which will tighten financial conditions and stymie economic activity.
You talked about the fact that there's going to be these waves of rotation back into cyclicals, into some of the value that's been created by the pandemic. How nuanced do you think that those investment decisions are going to be? Do you think that everything that's been beaten up is going to bounce back? Do you think at this point it doesn't really matter? You just cast a fairly wide net and you're going to catch some gains? Or do you think that as the year progresses, you're going to have to be significantly more selective? And if so, where?
Excellent question, Guy, really, because but I think the way to frame that question is to understand what sort of investor and what sort of risk appetite you have. So if you are someone more prone to trading, then you can buy big swathes of value, knowing that if you play for a bounce, then you can get rid of them quite quickly. It's not what we do at Deltec. It's not what I advocate as an investor, which is as a long-term investor. So certainly, we think you should be looking at high-quality components of the value space. So companies that might be cyclical, be sensitive to big gyrations in demand, and we've seen demand collapse in several industries like air travel, some leisure and retail as well. But we like companies that have very significant monopoly or duopoly type positions, very, very strong brands, unique asset values and so on. So if you like, and obviously the big piece that the traditional value analysis fails to capture is some of the intangible assets that are there. And if you select your value stocks with that quality lens applied, you can actually pick up long-term holdings at good valuations, and we think they'll benefit as much as some of the more beat-up names, but then you can be looking to buy and hold rather than trading in and out of them. So we would suggest reimagining value. Cheapness on its own isn't enough. Look for high-quality factors, so look for intangible assets, look for unique brand positions and market positions and so on, and then expect the waves to come as the revival leads to rotation.
Hugo, how differentiated are you going to have to be geographically in this move as you start your stock screening to pull out some of the factors you've just been talking about? Are we going to see those emerging earlier on one side of the Atlantic or the other? And I'm wondering whether or not kind of vaccine rollout is going to be a factor behind this. As you say, this is a return to cyclicality, a sort of a new cycle emerging. But for instance, if Europe is significantly behind the United States in terms of its ability to roll out vaccines, do you think that's going to have a meaningful impact in terms of the stocks you want to be selecting?
I mean, another excellent question, Guy. You've seen the differential performances between different geographies, how they've dealt with the pandemic and how that's actually led to very differentiated economic performances, and then by implication, some of the performances of the underlying asset markets. So, for example, China was so draconian in its lockdown and so quick with and large with the stimulus that's put out. Global trades recovered very, very quickly. So companies sensitive to global trade actually have been some of the best places to be. So and some corners of the emerging markets have also recovered much more quickly. Asian markets, South Korea, Taiwan, these sorts of areas have recovered very quickly. So you can assume that with the vaccine rollout and the effect that has on economic activity, you're going to see the same kind of dichotomies, the same kind of differentiation between different geographies. And you can say that the US has had a very, very bad pandemic in terms of the number of people that have been infected and died, but actually they have not sailed through, but the economic activity has been much more consistent, and hasn't fallen as far, has recovered. Okay, it's under pressure a lot now, but as you rightly point out, Europe domestic activity is still really in the doldrums. And we're in the middle of effectively a double dip in terms of European domestic activity. That's why we differentiate, let's say, looking at banks. We prefer US banks to European banks because we think the loan losses have been more or less recognized in the States. And now you're into a world where you're potentially going to see a more rapid recovery in terms of growth again. That contrasts with European banks. But then the European industrials have more export content, so they benefit from trade. So even within geographies, you have to be selective. But yes, your point about the difference between geographies is well made. There is going to be a significant difference in the exit, as there has been through the pandemic itself.
What we have seen consistently on both sides of the Atlantic, in fact, around the world, though to a certain extent less so for China, is a huge monetary push. I read in your notes this morning, talk about maximum monetization, and as a result of which you like things like Bitcoin and gold. How much further do you think that Bitcoin trade can go? We've touched 28,000. How much more?
Well, isn't that the $500 billion question? So starting with the thesis of maximum monetization, which we've had in place for actually 2 years. So we've had a lot of gold and a lot of alternatives for a couple of years. So we had a very large position in Bitcoin that actually has worked out incredibly well for our clients. how much further can this go? So if we ask whether maximum monetization continues, absolutely it does. The Fed is still buying $120 billion a month of assets. There is still a huge wave of monetary largesse, of monetary stimulus coming through. The ECB increased its programs the other day, so did the Bank of England. So this maximum monetization is still going on. Now, you can say it's in its last legs if we get the kind of recovery that we're talking about next year, but still unemployment, the output gap, it's too high. That support will still stay there. So undermining fiat currencies is going to continue. When it comes to Bitcoin in particular, the analogy is elephants trying to get into a crowded room through a narrow doorway. So institutional investors trying to get into this alternative non-fiat store of wealth, if you're brave enough to call it that yet, as they try and get in, they move the market every single time. A $50 million allocation for a large institution as a diversifier for their gold or alternative positions, it gaps the market up, and we think it continues, and we think it can continue really quite a lot further, despite the huge rally we've seen. Right. The actual number is difficult to define, but technically, having broken through its previous high, 19,600, it can go a lot further still, and we are holding big positions for our clients in that alternative asset.
30,000 certainly looks like it could be on the horizon very shortly. Hugo, we'll see whether or not that happens, or whether the regulators kind of pour some cold water on it. Hugo Rogers, thank you very much indeed. Deltec Chief Investment Strategist. What have we got coming up for you later on in the morning? Coming up on the Simplecast, Kathy Jones, Fixed Income Strategist, is going to be joining us to give us a conversation about where yields are going next. This is Bloomberg.
Se logra una sonrisa de parte de cada persona que utiliza el dispositivo, ya que se pone en situación, entre comillas, de una persona discapacitada, y ven que lo sorteamos de una forma agradable, porque el simple hecho de sentarse en un dispositivo ya es agradable.
Nace más como una solución de movilidad a personas con discapacidad, nace Mandados como una opción de generación de ingresos, y nace Mad Tools como generación de ingresos y educación a las demás personas que no están en silla.
A national holiday in the United Kingdom means light volumes for European equities today. Nevertheless, we are seeing a bid. We have the Brexit deal done. We have the stimulus signed in the United States. Both of those two significant factors in driving equity markets a little higher. The Bloomberg Dollar Index actually coming back up as we see the pound coming down. Up next, we'll talk more about that Brexit deal. Robin Niblett, Chatham House Director, is going to be joining us to talk about that deal. That's next. This is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Good morning. This is Bloomberg Surveillance. I'm Guy Johnson in London. Francine Lacroix and Tom Keane both have a well-deserved day off. Let's talk about Brexit. From finance to fish, the long-fought Brexit deal is raising many, many questions across the board. After 4 years, nearly 5 years of negotiations, leaders announced an agreement on Christmas Eve. But the deal leaves some, if not many, major issues still up in the air. Joining us now to discuss kind of where we go from here, Robin Niblett, Chatham House Director. Robin, good morning. The British pound is trading at session lows versus the US dollar and against the euro. The market seems relatively unimpressed. What is your assessment?
Well, I think the markets are just reflecting the reality of this deal. It was always going to be a bare bones, skinny deal. It is remarkable, A, because of the size of the economic relationship, over $700 billion worth of bilateral trade. I mean, it is huge in terms of the relationship. But It is a disintegration deal rather than integration deal. So what the two sides have done to each other, in a way, is make their economic relationship less effective more than more. So it's hard, really, to find positive news about it once you start stripping away the... So
Robin, when we look at what...
Go ahead.
Sorry, you're breaking up slightly, so let me jump in with a quick question. When we look at what happens next, is this just going to be a permanent Brexit negotiation that we are now going to find ourselves in? Everything is going to continue to be negotiated on an ongoing basis. If one side wants to change the rules, the other side is going to have to negotiate that, and vice versa.
Well, there's two areas where this is apparent straight away. One is in fisheries, where for the moment we have a kind of standstill arrangement for 5.5 years, but thereafter you're entering into annual negotiations of quotas. So that'll be a constant area of tension. More immediately, financial services, where the EU has said, well, we're not quite ready to grant equivalence yet to UK financial regulation, so therefore the bulk of financial services are not going to be able to be traded in an effective way between the EU and the US. So they're going to wait 3 months while they assess the standards, let's say, that the UK are applying. So you've got constant negotiation there. And then every time the EU increases areas of regulation on environmental standards, on phytosanitary standards for farm products, for example, they're going to have to check whether the UK is still in conformity or not. And if they're not, and it's going to impose some type of disadvantage to EU producers, the EU could apply or disapply some of the favourable treatment for UK goods going into the EU. So you can see we're going to be in an endless negotiation and reassessment of each other's steps for the foreseeable future.
Robin, as the politics gets taken out, though, and that discussion becomes more technocratic, do those deals become easier to do, or do you think that this will remain a constant sort of high-energy political story, at least here in the UK?
I think a lot depends on how well Britain is doing. I know that's a weird thing to say, but if let's say the Johnson government feels that its levelling up strategy is working, if it starts to come out of the COVID crisis to the end of 2021, then in a way it can leave the EU negotiations to go into the more technical, bureaucratic annual process. But the danger is that whenever things go wrong, you start to look for a scapegoat and an external enemy or problem. And historically, especially the Conservative Party has always seen Brussels and the EU as part of the problem. So any negotiation that is getting sensitive, as we used to have even when we were members of the EU on budget negotiations, for example, could then flare up. The British press will be looking for those dastardly Europeans over the channel as part of the excuse. So technically, we should be able to make this a more plain vanilla annual kind of process, but in reality, the politics will rear its heads at awkward moments in the calendar.
One of the objectives from the European Union side was to make it plain to any state that decided to follow the UK that life would be difficult, more difficult on the outside. Again, that must be an ongoing process. Again, is this going to make these negotiations more difficult and will increase the kind of political element within them?
I don't think for the moment, because the assumption is going to be that given that we now just have a plain free trade area between the EU and the UK, it might be zero tariffs, it might be zero quotas, but you have new requirements for regulatory alignment that needs to be approved on an almost product-by-product basis and constantly be reviewed. The assumption is the UK will no longer be quite as attractive as an offshore location for exporting into the EU market as it was prior to Brexit. So I think the EU feels that the impact, the negative impact, is likely to reveal itself over the next 2 to 3 years. The UK government, of course, hopes that they're going to be able to show that they'll be more dynamic outside the EU than they were before, and more attractive to foreign investment. I think until we start to see how those two stories play out in the next 2 or 3 years, both sides will keep their powder dry.
One of the ways in which that might happen would be to see further trade deals being done by the UK around the world. The key one, obviously, the United States. What is your assessment of the likely timeline to get such a trade deal done?
That's a very tough one. We know that a deal with the UK is unlikely to be as much as a priority as it would have been for Donald Trump if he'd been elected as president. So the Biden administration is not in a hurry to do this. Plus, you can remember Boris Johnson, I think, for all of the words about it, is not going to be in a hurry to do it if it means having to make concessions on US agriculture in particular that would look like it was undercutting some of the high standards of animal welfare that the British public like to believe they're part of, and genetically modified organisms. All of these types of issues are highly toxic, politically relevant in the United Kingdom. So I think at the moment the UK's got its hands full, trying to finish off the last few deals that it had as part of its EU membership. It then may want to look for some smaller deals that it can strike. Australia, for example, some countries where it could almost test its teeth, including on agriculture, with a smaller country that has less leverage over it. And in a way, I think both sides can afford to wait for a year or two. Britain is exhausted, and its negotiators are exhausted after doing this huge deal with the EU. Better to take a breather, let the Biden administration check itself in, show that the relationship is going to be okay, and then worry about this maybe in a year or two's time. That would be my guess.
Yep, I think we're all exhausted by this whole process. Well-deserved holiday today. Robin, thank you for joining us on it. Robin Niblett, Chatham House Director, we greatly appreciate your time. Okay, let's check in on the headlines that you need to know about. Here with the Bloomberg First Word News, it's Rebecca Gupta.
Thanks, Guy. The UK and the EU have finally signed a post-Brexit trade deal. But speaking to the Sunday Telegraph, Prime Minister Boris Johnson admits he doesn't go as far as he wanted on financial services. There's still little clarity on so-called equivalence that allows firms to sell their services into the EU's single market. The UK is poised to approve the COVID-19 vaccine produced by AstraZeneca and the University of Oxford. Bloomberg sources say the regulator could clear the shot for use early this week. The Sunday Telegraph reports it could be rolled out from January the 4th. The UK has already vaccinated more than 600,000 people using the vaccine from Pfizer and BioNTech. The European Union has begun a coordinated vaccination campaign less than a week after clearing the shot by Pfizer and BioNTech. It will take months to vaccinate enough people to have an impact on the spread of the disease. European Commission President Ursula von der Leyen says it will be a gradual process and caution is still needed. Global News 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rebecca Gupta. This is Bloomberg. Guy?
Rebecca, thank you very much indeed. Back to politics next. Sharon O'Halloran, Columbia University Professor of Political Economy, will be joining us. We'll talk stimulus, we'll talk trade. That's all coming up next. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen.
And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
So this is Bloomberg Surveillance Monday morning. I'm Guy Johnson in London. Francine Lacroix and Tom Keane both have a well-deserved day off. But let's talk more about what is happening stateside, particularly the president's decision late last night to finally sign the relief bill, the $900 billion relief bill. We've also averted a government shutdown as well. This is going to have meaningful impacts in a number of areas. Clearly, the economy is going to benefit, but there has been a delay, and that's going to be a drag. And then we need to think about what is happening with the Georgia runoff as well and what impact this is all going to have there. Sharon O'Halloran, Columbia University professor of political economy, joining us now to give us her take on all of this. Sharon, the president finally signing the relief bill late last night. We do have a week's delay. That's going to cause around 14 million Americans to not get a week's worth of extra employment benefits. That's going to have a huge effect. But going forward from here, we now finally have this behind us. Kind of what does it do in terms of the impact it's going to have on the U.S. economy, and what effect is it going to have on U.S. politics as well? Can we now kind of basically have a relatively straightforward transition into the Biden administration?
So, you know, a little high drama, a la Trump as he goes out. So that's what we anticipated. And what we also see is that this is good news for a lot of individuals who are going to benefit from the $600 checks that they're going to get. They did extend the unemployment, even though their insurance benefits, even though there's going to be a break. So for all of that, this is positive. It is a large package that has lots of things involved in it, that some are very relevant, some are to help sort of middle class or working class Americans. Others are perhaps less directly hitting people, but I mean, there is going to be relief for rental assistance. There'll be, you know, the paycheck protection programs, the student loan relief programs. So those are all going to have really direct impact on making sure that people can make it through for the next couple of months.
The